This year has all been about the whipsaw.
We don't think rates are going to continue to fall right here. We think we're going to see them turn around.
We're not in that camp that we're expecting the Fed to turn so quickly.
I think the market is possibly getting ahead of itself in terms of pricing cuts.
Could there be rate cuts coming in 2024? Sure, right? But we think there's going to be one more hike this summer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It's emotional. We're back together. It's a beautiful thing. Live from New York City this morning.
You're talking about Sergio.
Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Equity futures positive by almost 1% on the S&P 500. Emotional about Ermotti as well, Tom. Back in a seat. Hammers is out. Ermotti's in. The Swiss are back.
The Swiss are back and the Swiss are furious. I'm going to make note that, yes, it's about financial wealth management, IB, blah, blah, blah. This is about domestic politics. This merger made in hell, and the Swiss people are absolutely livid. This is about, as was mentioned in the press conference, a bad culture at Credit Suisse. That was stated by the UBS people. They have the known in Ermotti, but what they really have here, John, and you know the landscape, north of Italy is Ticino. This is the kid from southern Switzerland to the rescue.
So 3 points to make. One, yes, the man from Lugano is back. Two, he's run the bank before, so great, he's got the experience. And three, it's what he did with the bank at the time. He wound down the investment bank in a big way. And I just wonder if that's what this is really all about, Tom. Identify what they need to do, Credit Suisse, wind it down.
His skill set, and this is off of years at Merrill Lynch as a trader, is not the success or the buy or the thing. It's what you don't do. And what he's very good at, it appears, is to say, no, we're not going to do that. And to go against the obvious. And right now he's got to go into, say, Asian wealth management and say, how do we do this and keep the business, and in investment banking as well. But again, John, I'm going to circle back to 70% plus of the Swiss people are livid over this merger.
Lisa, UBS this morning up by about 1.6, 1.7%.
There is now a focus on integration, not necessarily a focus on simply growing profitability and growing some of the other aspects of the business. Now this is about trying to make a bank more seamless. To your point, the restructuring skills that Sergio Ermotti is really respected with, at least in terms of his tenure at UBS previously, seems to be one of the main pulling points here.
So we're going back to move forward.
Right.
So that's UBS. The President of the United States says crisis over. Didn't quite say that, but came close, didn't he? Crisis over?
Yep, it's all over. And this is a problem that we've taken care of. And clearly it was an issue of bad management. And now the question is, why was it missed? And oh, by the way, it wasn't missed. So here's the question. If it wasn't missed by Fed regulators at San Francisco, then what are we talking about here? And that's a real issue right now for regulators and for politicians.
So based on the hearings yesterday, and we get another set of hearings today, and I know you'll go through the Times in just a moment. Based on the hearings yesterday, Tom, this goes back to late 21. So what we want to know, and what I didn't get out of yesterday, is when did the Board of Governors find out about all of this? When did Chairman Powell know all about this? And if they did know, what on earth did they do about it?
Yeah, that's going to be the autopsy of it. I would suggest the markets will ignore this in its entirety and move forward, as you say, crisis ended, as the president discussed. And the answer is the markets right now, looking at the screen, John, as you've been gone at your interview with Tottenham to be their next coach. And that didn't work out, right? Conte's gone, right?
Conte's gone.
Conte's gone, and, you know, it's a long list. But the answer here, John, is simple. The markets are voting with the President of the United States and saying we're moving beyond this crisis.
For the bank sector specifically, though, I don't think we can move on yet. We've
got
to
work out
what the regulatory regime is going to look like. And I think you can split Washington, D.C. down the middle. You've got the sensible people who think it's about two things, and then you've got the not-so-sensible people who are drowning in politics who think it's about one thing. The Democrats think it's about we need more regulation, and the Republicans think it's all about a lack of enforcement. Lisa, it's probably a little bit of both based on what we heard of yesterday.
And it seems like there's some other proposal percolating out here, and this was sort of a little talked about aspect. The FDIC chair came out and made a proposal of a special assessment made in May of existing banks to cover the costs for Silicon Valley Bank. So they're going to pay for this. Now, what kind of precedent does that set? And this, to me, is going to be really a discussion point going forward.
What's great about this, to overlay it, bring it back to Mr. Ermotti, they're having the exact same discussion in Switzerland. There's a conservative group in Switzerland, a conservative ascendant set of the 26 cantons, and the conservative crew is saying, let's get them. We want clawbacks from Credit Suisse, et cetera, et cetera. And then the liberal group is saying, well, at least we need more regulation. Let's remember that, like, we have '08, Or we have Continental Illinois. They have 1997 when Swiss Banking Corp, SBC, took out UBS. They renamed it UBS because that was more marketing pleasing in that. But the overlays here of both bank crises lead to this regulatory debate. Same thing.
Let's get this morning started. Tom, equity futures right now up 0.9% on the S&P 500. Just the flavour of the price action. The relief continues, and I guess no news is good news on the banking front. That's the ultimate story here, Tom, for risk.
Some of this is correlated moments ago. West Texas Intermediate, 74. John, $69 to $74 in American oil. That's one of those little tea leaves of correlation that give the president confidence in his reports.
The 10-year yield, 353.93. We're down by about 3 basis points there. Lisa, down about 7 on a 2-year. The front end, though, still in and around 4% on a 2-year yield.
Yeah, but kind of whipsawing around. To your point, though, it's still way off some of the highs that we saw in terms of 5.1% 2-year Treasury yields. Today, yes, there is an absence of real data, but there is lots of hearings and lots of navel-gazing. 10 a.m., we get more of it. Fed and Treasury officials testifying yet again before lawmakers about Silicon Valley Bank. I want to hear from the FDIC chair about this payment program from other banks. I want to also understand, to your point, John, what was the problem with the oversight? What was the problem with the enforcement actions that didn't come with respect to Silicon Valley Bank? At 10 a.m., we get pending home sales. This will be interesting because yesterday we saw that home prices didn't decline as much as people were expecting. Do we see sales continue to decline at a pretty rapid pace, or is there a continued plateauing as people kind of realize, okay, mortgage rates are kind of going to hover around here or even go lower? And today, the NABE conference, the National Association for Business Economics conference, is taking place in Washington, D.C. Among the speakers, Rich Clarida, former Fed Vice Chair and friend of this show, Catherine Mann of the Bank of England, Seth Carpenter of Morgan Stanley, Tobias Adrian of the IMF, and Isabel Schnabel of the ECB. How much emphasis is there, John, on inflation at a time where everybody seems to have moved on to crisis? Maybe perhaps there's a pause in terms of the news, but there is not a pause in the angst underpinning this feeling that we are on the precipice of a deep, steep drop-off in growth.
Lisa, thanks for that. I looked at that lineup there, Tom, and just thought, why aren't we there?
Major shout out to the legacy of John Sylvia and Diane Swank, who's been actively associated with National Association for Business Economics. McKee is very active. I was very active for years. That's the best lineup of NABE.
Very cool, right?
I've seen for years.
We'll bring you some headlines from that when it starts. Let's get to Jeff Yu, senior market strategist at BNY Mellon. Jeff, I think reflecting on yesterday, and thanks for being with us, Jeff, reflecting on yesterday, just trying to work out whether we have a regulatory problem or an enforcement problem. Which one is it?
Morning, John. I think regulators, politicians, all of them, they are going to be looking at this globally. Tom, you mentioned after each event over the last few decades, they do have the discussion at least. Now, I'll just point you to what Sam Woods, head of the PRA, said yesterday, already calling for a tightening of liquidity rules, so liquidity coverage ratios, to make sure that all banks, have enough cash, right? So I think it is going to be a bit of both, looking at the global situation. But crucially for central banks right now, they also really want to steer the discussion away from the impact of monetary policy as well. Financial stability, price stability, they are separate.
Jeff, you're at London School of Economics this morning, and Magnan Lord Desai's down with a piece of chalk in his hand, and he's lecturing on the general equilibrium of the system. Are we super restrictive right now in our general equilibrium? Are we at a point of over-restriction?
Well, as part of a dynamic process, it really depends on where your starting point is, right? I think all of them would agree with that. But the problem is you only find out you are too restrictive, after the fact. But based on all of the communication we've had from global central banks, and everyone's taking a leaf out of Madame Lagarde's book, right now, they're still comfortable hiking rates, inflation, managing price stability, that has to remain the priority. And as long as that's the messaging, and looking forward to hearing from that lineup, as you mentioned, I don't think we are in fully restrictive territory yet. You look at credit spreads, you look at where the dollar is. I think policymakers will say they can do more.
When will we start to see, Jeff, the effects of potential credit tightening from some of these regional banks? When will we get that data?
Well, I think the data, we really have to monitor twofold. One is just basically the credit data. Is loan demand, loan growth, and loan officer surveys, are they picking up? Are they showing a clear material sign of things coming off? But at the same time, then the realized data, the hard data, are mortgages, are they starting to come off? Mortgage approvals, things like that, globally. But that will take time. There is a lag process, as Governor Bailey has highlighted. But let's be clear, the event over the last few weeks has been an equivalent to tightening. It'll be different in different jurisdictions, but this certainly has slowed the overall process of rate hikes.
Are you sympathetic, Jeff, to the stock bulls who are saying, if you look around right now, things still look good. And if the Fed cuts rates, that'll make things only look better. So perhaps you can worry, but you're just worrying in a sort of vacuum of information.
Yes, I am sympathetic to risk on, but nothing to do with the Fed. If anything, I think the Fed and global central banks, they will keep rates higher for longer. Not super high, as we've feared in the past, but they will be higher for longer. The reason we can be positive on risk, data aside, cash on the sidelines. There is just so much sitting there looking at our investor flows, and we put out a report on this recently. There's no conviction. People at almost like limit underweight risk assets, and it's quarter-end rebalancing, month-end rebalancing. We've had another adjustment lower. People are underweight risk relative to benchmark. We're seeing that in our data, and that in itself is a tactical reason to see risk on across all asset classes.
So I think the Nasdaq has had one of the best quarters going back to 2020, Jeff. Now, this quarter's still got a couple of days to go. But based on what you just said, Jeff, where's your favourite place to take risk at the moment?
Well, right now, I think within FX, we are looking at emerging markets. This is the area which was heavily sold last year. I look at our month-end rebalancing models. We're looking at being positive on the Mexican peso, for example. We're seeing buying in Eastern European sovereign debt. That's where you get good nominal yield, maybe good real yield up ahead. Inflation in Europe slows as well. So really, I would favor EM. But if you look at EM beta to tech, for example, you can see that they're probably quite aligned right now. And that's why we are seeing risk rally across the board. But let's be clear, this is less of a fundamental story, more of an asset allocation story.
Hey, Jeff, I hear you. Thank you for that, sir. Jeff Yu there of BNY Mellon. Jeff Yu of BNY Mellon there, Lisa. On the risk that they want to take, and you and I joked about this last week, couple of days, stocks do okay, and it's like crisis is over, yeah. Let's move on. Where do you want to take risk?
That's basically what we're seeing right now. The absence of information is a wonderful thing. Everybody says, yeah, and let's go into bonds, and let's go into stocks, not bonds. Stocks, let's bonds sell off a little bit in bonds. What I thought was interesting, though, over the past 2 days, the Nasdaq has underperformed. So are we repricing into back the cyclical moments and this new higher rate regime? Not sure.
You asked the right question. How long before we find out what kind of damage we've done here? And Tom, May 3rd is the next Fed meeting. I struggle to see how we've got enough time between now and then to work out how much of this is a substitute for rate hikes.
Totally agree, and I agree with that in terms of the needed data dependency. Are they going to have enough data to make an informed decision? I think maybe in our entire history of doing this is the meeting where that's the case.
Equity futures on the S&P up 0.9%, live from New York City. Going to be back together. This is Bloomberg.
Yeah, it's okay.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Swiss banker Sergio Ermotti is returning to the role he had for 9 years. Ermotti will once again be CEO of UBS to oversee its complicated acquisition of Credit Suisse. He's replacing Ralph Hamers, who's been CEO for just over 2 years. Ermotti will take over after next week's annual general meeting. Hamers will stay at UBS for a transition period. Now, Ukraine's President Volodymyr Zelensky warns that a Russian victory in the city of Bakhmut could be perilous. He told the Associated Press that Moscow could then build international support for a deal that would force Ukraine to make unacceptable compromises. Zelensky also invited China's President Xi Jinping to visit despite China's ties with Russia. A warning from China for Taiwan's President Tsai Ing-wen and the US. Tsai is on a trip that involves US stopovers. Beijing says any meeting between her and the House Speaker Kevin McCarthy would be a serious provocation. Tsai is expected to meet with McCarthy in LA. China-Taiwan Affairs Office says a meeting would severely violate the One China principle. Now in France, allies of President Emmanuel Macron feel that street violence aimed at his pension reform is spiraling out of control. Supporters in the National Assembly are still backing the controversial plan, but several of them are urging Macron to find a way to take the heat out of those demonstrations. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Live from New York City this morning. Good morning. Let's get you a sense of flavour of the price action. Equity futures elevated up 0.9%. A rally in the bond market, yields lower on a 10-year by 3 basis points, 350, 355 on a 2-year, down 7 basis points, just north of 4% on a 2-year yield. Looking at UBS, positive in Swiss trading, up by 1.5% over in Switzerland. The man from Lugano is back after running the bank for the best part of a decade. He's back in a hot seat, Tom, at UBS, Sergio Ermotti.
Cultural as well, of a nation of 3 languages, and this is Italian. Lugano's basically, John, help me here, 100% Italian, southern Italy.
Right on the border.
Down
if
even
you know
below
where
Davos.
Lake Como is, it's just north of that.
You wave to Lake Como.
There you go.
Right. George, how you doing?
Something
great.
like
Francine, you're at whatever the meeting is.
Ambrosetti.
There you are. Hi.
Chernobyl.
And he's from there, and this is a guy who was obviously good at academics and that, and Johnny was a footballer. He really wanted to play pro-European football, and he ended up doing the combat of trading at Merrill Lynch. That's really the experience he brings to all of these great financial challenges.
I imagine you get paid more running UBS for a decade than maybe being a football player.
And going through unit credit as well.
Perhaps.
I mean, there was some
Depends who you
it depends
are.
how good you are, obviously.
Beckham,
But I think he's done okay.
To the Swiss crisis here, it's not just about Geneva or Zurich and comfort. This is about the people of Switzerland in a complete, total uproar at the canton level.
We've got to think about where Ralph Hammer's come from. He comes from ING.
Yeah.
Right. He goes to UBS, and all of a sudden he's going to oversee that beast. And we were talking about that a couple of weeks ago. Phenomenal to go from ING to UBS and then run the combined entity of UBS and Credit Suisse. So one, he was Dutch and this guy's Swiss. I hear you. It's a point. It's a valid point. But two, it's the guy who used to run this business, a man who's probably thought a lot over the last decade about what that combined entity probably looks like. And three, the problem child of Credit Suisse was a problem child of UBS that he dealt with about a decade ago. That's important.
I think it's really important that Hammer's expertise is more of a digital, modern banking expertise, and that's not what's needed right now. What's needed is what do we do with 15,000 people?
I agree.
No, it's just that simple. I mean, there we are in the market again. I really want to emphasize, folks, a nice move. What are we, John? 4.01% on the 2-year yield.
Crisis over. It's done, Tom. Move on.
There it is.
The president says we've done what we need to do. We're settling down. That makes me nervous. I don't know about you.
Yeah. What made me nervous was Victoria Fernandez yesterday quoting the Dow Jones Industrial Average.
Oh, there we go.
You were gone.
Nice.
She shouted that out. Right now, shouted out is the true expertise of Europe that we get with Jan Patrick Barnard. He's in Frankfurt with true banking experience and his journalism at Bloomberg. Because so there I was, Jan Patrick. I'm going, why didn't I see this 5 days ago? Ermotti, of course, should come in and redo this ballet. What's his first order condition with the Swiss people, with the domestic debates of UBS Credit Suisse?
Well, I think he has to figure out 2 things to get this merger going. The most important one is like what to do with the Credit Suisse operating unit that is serving retail and wealth management clients. And there are a couple of issues with that coming from the regulatory side, coming from the political side, coming from the public side, but also like within the new entity, like how much overlap is there in terms of clients, how much business will they lose because just people say like I don't want to have like all my money with like just one entity, especially what we have learned over the past couple of weeks. And the other big one is like what will he do with all the risk and all the problems that Credit Suisse, especially with the investment banking. UBS has done a very well job to slow that area down, and now this is kind of not a step back, but something like that, and he has to figure out like, okay, how do I want to handle this? Do I want to spin it off, or how can I integrate it in the let's say UBS smaller investment bank?
The memory here, Jan Patrick, is SBC taking out UBS. They called the entity UBS, but it was a takeout by Swiss Bank Corporation. They brought in Dylan Reed, SG Warburg. They built out the growthiness of investment banking and all that. That was based on 2 different cultures in 1997. What's the difference between an investment banker at UBS and an investment banker at Credit Suisse?
Well, I think like the UBS investment banker has well understood and is aligned with the concept that UBS has been running, that the investment bank is kind of a service entity to the greater good, which is wealth management and servicing all those clients that UBS has at the core of its business. Credit Suisse tried to do the same, but they haven't aligned the business in the same perfect way that UBS has done. So I think, like, for everyone working in the Credit Suisse Credit Suisse Investment Bank, it's time to change that. And they going forward, I'm very sure that UBS or the new entity, whatever it will be called or how it will be run, will make sure that wealth management and everything around this is at the core, and the investment bank is a service entity towards that core, and that is the big change for Credit Suisse.
Early this morning, the chair of UBS said this is the biggest single financial transaction since 2008. I would argue it's bigger than any deal done in 2008, saying this is the first time that two systemically relevant banks have merged and bring significant execution risk. Do we understand, Jan Patrick, what that execution risk really looks like?
Well, I can't note more enough than this. It is not a mega merger in terms of market value, but it is a mega merger in terms of operation and operational risk that they have to figure out. And I think the market is appreciating that. We know about the risk, that there is big opportunity in there for the new entity if they manage to pull this off. But there are lots of question marks that they have to figure out in terms of real operations, about public perception, about political pressure. And all those things. It's to me, it's brilliant and very smart to bring the former CEO back in, because he knows the entity. He's well regarded in Switzerland, and I think, like, what UBS is doing is like setting the whole operation up for a perfect start with the perfect person in place to make sure that you have someone there who knows all those risks, who is aware of them, and who is probably in the best position to tackle them as fast as possible.
This is kind of a dumb question, Jan Patrick, but this morning I was looking around and trying to understand, what has Sergio Ermotti been doing for the past 2.5 years?
That's a good question. I mean, he was chair of Swiss Re, so he was not fully out of the financial business. And I guess, like, as always, if you have run an entity for so long, he probably would have stayed in touch with UBS, at least in a let's say informal basis. Also, UBS hasn't changed dramatically over the past 2 years, so I would say, like, that even though he has been out of the business for 2 years, he's still, like, let's say 90% in the know of what's going on at UBS, and that's probably a good thing.
Jan Patrick, thank you. Jan Patrick Barnett there of Bloomberg on the latest with UBS. I woke up to messages from Bloomberg's Manus Cranny on this morning. You know when you read a headline or a news story and you sit there and you think, why didn't I think of that? You know, it was like exactly everyone's saying, I'm shocked, I'm surprised. But I sat there thinking, this is so obvious. I'm just annoyed I didn't come up with it. It was just so obvious, Tom. It makes perfect sense.
100% agree. There I was when I got up. It was like at 4:30 this morning, and I just said to myself, you got to be kidding me. Why didn't I know that 5 days ago? Best interview with Ermotti ever, and this goes to the spirit of the football player. Manus Cranny on a sidewalk against a pointed iron fence. Cranny was ruthless. He was grilling the gentleman from Ticino. Grilling him, I say.
I will say my first thought was not, how did I not think of this? My first thought was, what was that conversation like? Was it awkward? How much did he demand from them? Why did he leave in the first place? Did he think that they kind of messed it up, or did he think that they took it in the right way? This
is so urgent. I don't even think they've gotten done with the how much did I demand from you.
Oh, interesting.
This is I can't convey enough. Matt Miller helps me with my fractured German. He laughs at me. I've got the drink in the hand, and Matt's like, built, and the different newspapers over there. You should see what's in those newspapers. It's not like in America.
But skip that.
I had no idea. But,
wow.
But Lisa, what's serious here? The German papers and the Swiss papers in German, they're fiery with the emotion of the moment. I don't think he's got a compensation package. It hasn't been figured out.
But do we have a sense of why he left and what kind of cultural overhaul will have to take place when he comes back?
The forgotten man, can we just mention him? Haven't heard him mentioned all morning. Andrea Rochelle. He's the guy that did the work for Ermotti to wind down the investment bank and restructure things, and he's now running UniCredit. But that's the name that's absent in this conversation this morning. Now, I'm not saying he's coming back too. I don't think that's happening, but I think it's a point worth pointing out, Tom, that he was the guy that really did the hard work for Ermotti with that investment bank.
And also someone who's been wonderful with the show, including an important interview in Washington. Axel Weber is the one I believe that really brought in the Dutchman, Mr. Hammers, over to UBS, and you wonder where the former head of the Bundesbank fits in as well.
Haven't talked much about the Fed in the first 25 minutes of the Fed show. What's that about? Brian Weinstein of Morgan Stanley is going to join us shortly. He joins us next. Equity futures up by 0.9% on the S&P 500. Great note from Seth Carpenter of Morgan Stanley over the weekend. We'll touch on that in a moment. Equities are doing okay, positive on the S&P and on the Nasdaq too. In fact, we're flying here. We're doing better than okay. We're up 0.9% on the S&P, on the Nasdaq up 0.9% as well. On a Russell, heavy weighting towards the financials, the regionals doing okay as well, up by more than 1%. So waking up to a better equity market. Looking at the bond market that's rallying with yields lower on a 10-year by a couple of basis points, 354.50 on a 2-year, just hanging in and around 4%, 4.0269 on a 2-year, still down about 5 basis points on the day. I'm really wondering, guys, what difference the incoming economic data is going to make to this conversation around Fed rate hikes. And we mentioned in the last 10 minutes or so, Lisa, whether a month, a little bit more than a month, is a sufficient amount of time for the Fed to find out how much tightening the bank situation has done going into their next meeting.
To put another way, can we look at the data with any reflection of reality, considering that supposedly there's a lag effect of some natural credit tightening from some of these regional banks? So do you shrug off all of the data? And which data do you decide to shrug off? I mean, basically, do you embrace the inflationary data and shrug off the ones that are weaker, or do you embrace the weaker data and say that the other ones will just get remedied by tighter financial conditions?
You can see what the bias is right now, Lisa.
Exactly.
The bias seems to be if it's good, ignore it, it'll get worse, and it's bad, it's going to be really bad. That's what it feels like to me going into CPI and to payrolls over the next month or so.
Which is the reason why the Fed can cut rates by 100 basis points by year end, and everyone's going to be happy.
Yeah, the heart of it to me is claims is tomorrow, 195,000. They have not seen the labor economy break yet. Period. To me, that's the traditional model here.
I totally agree. This is what Jim Bullard of the St. Louis Fed has got to say on this.
Yeah, I read the note.
Here's the quote. In my view, continued appropriate macroprudential policy can contain financial stress in the current environment, while appropriate monetary policy can continue to put downward pressure on inflation. I struggle with this. I struggle with all these takes. And I have to say there's some daylight between that take and what the chairman of the Federal Reserve communicated to us all last week. Is policy really in conflict? Seth Carpenter and Morgan Stanley. Take a listen to these lines. Central banks are deliberately tightening financial conditions in order to slow their respective economies and thereby bring inflation down. What the bank's disruption does, however, is make it harder to calibrate the correct degree of tightening. This is about calibration of policy.
Yeah.
It's not about policy being in conflict. Yeah. I struggle with that.
I think Carpenter's onto something here. And to Bullard's credit, in his very carefully written note, he leads with the Bloomberg Financial Conditions Index and the Goldman Sachs Financial Conditions Index. And as you say, those indexes are fine. Let's say there are 11 ratios, summed together with a lot of math that only Kevin Cleason at the St. Louis Fed understands. The bottom line is, John, adults have to calibrate in real time with real-time events where you wonder if those financial conditions indexes really have efficacy.
They want tighter financial conditions, and we'll see this in those so-called senior loan officer surveys that we're going to get, and everyone's going to pay tons of attention to. I'll say this up front. It's not the clean way of doing it. It's a dirty way of doing things. But ultimately, wasn't this the goal? And they've effectively told us now, the chairman said himself last week at the news conference, Lisa, you and I listened to, and many others did as well, that this was a substitute for rate hikes. To what extent it will be a substitute, that remains to be seen. But that doesn't sound like a policy conflict to me.
There's a discomfort in the chaos agent of a banking issue. There is discomfort in the unknown of the tightening effects. There is such an unease right now of the unknown, and you're entering into that with a, to use your word, Tom, stochastic type of situation where you end up with sudden breaches and potential credit fissures, and that creates a different scene than sort of rhythmic increase in yields.
In the analog of stochastic math is you're catching a knife in the dark. And maybe that's what the Fed is doing, trying to get to May 3rd. I'm looking at a Bloomberg Financial Conditions Index. I'm going to use a sophisticated math phrase.
Here we go.
It's very in-betweeny. You know, that it's got a real uncertainty at a -0.5 standard deviation. It's not there. Only one I know that knows this math is Brian Weinstein. He joins us now, head of fixed income at Morgan Stanley Investment Management. Brian, you were dozing off there listening to us actually pretend like we know what guys like you are talking about. Over the desk at Morgan Stanley, what is the level of the uncertainty right now?
That's the great word. I think it's high. The level of uncertainty is high. And talking about conflict, I don't think the Fed sees them having a policy conflict, but the market certainly does, right? The market says, hey, we're just going to ease a couple times this year and everything, and risk is going to be fine. It's unlikely, right? I think, Lisa, what you were saying is right. This was ripple number one, and we don't know what it's going to cause. We know the government can help us backstop the deposit base, but we don't know what ripple number two is. So I think risk premium in the markets has to go up.
So much of this, and James Bullard lays it out in the beautiful chart he's got from Kevin Cleason and the team in St. Louis, is the magnitude of the moment. Clearly, in terms of financial stress, it's not 2008. What's the level of magnitude measured at Morgan Stanley?
It's not as bad as you would have guessed, right? We had, all this investment grade issuance this week, $20 billion, right? I think yesterday was the number. High yield markets open. So you see it in the front ends of small banks, right? You see stress in very specific markets. We've moved wider. You've steepened the curve, but you don't see anything yet that points to very large levels of distress in liquid financial markets.
Are there reasons to believe that developments over the last couple of weeks, Brian, will lead to a disinflationary bust? Because that seems to be what we've priced in the bond market.
Yeah, I think the risk has gone higher, for sure. The Fed is going to speak a lot, and you guys are hinting at this, about long and variable lags, right? They don't know what the impact of all this hiking and the banking liquidity squeeze is really done. And the truth is, I don't think it's increased the risk of inflation, right? It slowed down the economy. It will slow down lending. It will slow down inflation. Does that mean if the inflation is dead? We're not going to know for a long time. But the risk of disinflation and the risk of a bust is definitely higher.
So, Brian, where does that leave your call on high yield credit?
I think you can continue to own it cautiously if you want the income, but I think that safer bonds are better, right? We've already had a move in treasuries. I'm not sure you want to chase that market yet. Investment grade credit looks pretty good if you can lock in that yield, and we've already had the banking crisis in those spreads, but I don't know that you need to chase risk. If what I said about risk premium is true, you'll get better chances.
You said if we've had that banking crisis in credit or reflected in spreads, have we? Has that been reflected?
You've had it in the front end, for sure. If you look at the kind of 2-year securities of banks, they've certainly widened a lot. But Lisa, I'd point out, it has the risk to large bank bondholders. Is it really high, or are they much safer than we thought they were? Right? I think that it's going to be very hard for me to make a claim that large bank spreads are at risk here, when the truth is they're part of the solution. They're helping us get out of this. So yeah, I think an investment grade, not that it can't go wider. But I think you've had a reasonably large move there, larger than you've had in say, high yield markets.
Hold on a second. Does this mean that you've been loading the boat on bank bonds? Is that basically what I'm hearing here?
Yeah, listen, I think the senior debt of large banks again, if you look at the tenure note at 350, so you're going to get 5.5% for 10 years. Is that the highest level we're ever going to see? Maybe not, but I think it's a good thing to own in the grand scheme of things. So yeah, senior financial debt looks like a good buy.
When you take a step back, you ask a question that I think is fascinating. Do risk assets do better or worse when rates are high? What is the answer, and how counterintuitive is it?
It's a little counterintuitive, right? We haven't been at these yield levels in so long that we saw significant client inflows as we had the sell-off, right? Even though spreads didn't widen that much. So I think higher yields does bring in buyers. We've definitely seen that. Now there's the perverse part, and the part we haven't seen yet. The funding cost being higher is worse for corporate profitability, right? So there is a cost to it, which we really haven't had a chance to digest. It's been a while since we were up here. But as far as your question, investors come in when yields go up, and they haven't seen these yields, and this is the first time in years.
Brian, explain to mere mortals, including Morgan Stanley clients right now, the permanence of these higher interest rates. It's not that there's a wistfulness to get back to low interest rates, but maybe there's a belief there'll be a dampening of rates somewhere down lower. Or do you ascribe to the idea that there's a permanence to a new higher rate regime?
I think it's hard for the Fed to go back to zero. Again, not that they wouldn't. We know the tools they have in their kit. But I think there's a permanence to the psychological inflation that we've seen. The idea that we went through this big disinflationary period where no one believed inflation was possible. It's hard for me to believe we're going back to a world where everyone believes in disinflation again. So I think about it, 10-year notes are in a 2.5% to 4.5% range. We haven't gotten to 4.5%. We're sitting right in the middle. It seems like a cop-out, but it just happens right in the middle of that range. So yes, I think people who think the Fed can go right back to zero and make this easy for risk assets are mistaken.
This is only the fifth regime of the last 2 months or something like that, Brian. Brian Weinstein and Morgan Stanley Investment Management. What a change. Just want to look at Deutsche Bank just quickly. The stock is up by 1.24%. That stock's doing fine. Fantastic reporting coming from the team overnight. Nicholas Comfort, Steve Ahrens. There was a roughly $5 million bet on Deutsche Bank CDS.
Was that Abramov's
on
kids?
Friday. So this according to people familiar with the matter. And this is a classic case of the tail wagging the dog. Because of the illiquidity in this market, reportedly all it took was a bet that size, Lisa, to shake this market. And then ultimately you take the read from CDS and you're like, oh no, what's happening here? And the equity gets sold off hard. And that seems like what the story was on Friday. A lot of people were scratching their heads. Why is DB down so much? What's going on with CDS? And based on our reporting, Lisa, this is what happened.
This just basically emphasizes some of the investigations in Europe into the credit default swap market, because this particular trade caused 1.6 billion euros of market value to be stripped off of Deutsche Bank in one day. And so people are saying, how can this be if there's one person manipulating an entire market for all the instruments tied to this bank based on one bet? What does that say? It'll be a discussion.
At Deutsche Bank, every time there's trouble, just sort of get brought back into it. You know that scene in Casablanca, round up the usual suspects?
Yep.
Every time something goes wrong in banking, it's like round up the usual suspects and you knock on the door of Deutsche Bank and have a look. Deutsche Bank is not the Deutsche Bank of several years ago.
Correct.
And that's the frustration of a lot of people, Tom, that hold this name. That reputation hasn't gone anywhere.
I just watched Casablanca again.
Did you recently?
We had the afterthought. She's decided she's a film major. Where do you start? You start with Casablanca. Every time you watch it, it's a different movie. But they rounded up the usual suspects at the end.
Well, can I just add that it also is perhaps mistaken identity as well, because there was this Deutsche fan brief that didn't buy back some of their AT1s or didn't sort of repurpose some of those bonds. And so people misread that for Deutsche Bank. I mean, there were so many rumors going on last week. And now the fact that they've subsided seems to be, okay, party on.
So I've got a headline from the Senate Finance Committee chairman.
It's quite a headline.
Credit Suisse is still aiding tax evasion, according to US Senate panel. And Tom, the UBS acquisition does not wipe the state clean. Now, this is exactly why UBS wanted some state guarantees around some of the costs around this deal, Tom, because you inherit regulatory and legal issues when you take over another bank in this environment, and that's maybe where this is going.
Ermotti needs this morning. At the center of this investigation are greedy Swiss bankers and catnapping government regulators, and the result appears to be a massive ongoing conspiracy to help ultra-wealthy U.S. citizens to evade taxes and rip off their fellow Americans.
Wendy Schiller of Brown University to weigh in on some of this, maybe, coming up.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. President Biden and House Speaker Kevin McCarthy exchanged dueling letters in the fight over raising the debt ceiling. McCarthy is demanding that negotiations begin on a series of spending cuts and regulatory changes. The president responded by challenging Republicans to produce a public budget plan. Now, President Joe Biden is urging Israel's Prime Minister Benjamin Netanyahu to reach a compromise on his controversial plan to overhaul the courts. The proposal has sparked protests across Israel. The president told reporters, quote, they cannot continue down this road. Vladimir Putin's drive to expand Russia's armed forces is adding to labor shortages. The war in Ukraine has drawn hundreds of thousands of workers into the military from other sectors of the economy. Government data suggests a net increase in Russian military last year of approximately 400,000. That comes at a time when unemployment is at a record low. Now, Bloomberg's learned that JP Morgan Chase CEO Jamie Dimon will be deposed over the bank's ties to the late financier Jeffrey Epstein. The deposition is connected to two lawsuits brought against JP Morgan by an alleged Epstein victim and the US Virgin Islands. Epstein was a JP Morgan client for 5 years after he pleaded guilty to soliciting a minor for prostitution. Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
This is a textbook case of bank mismanagement. The risks the bank face, interest rate risk and liquidity risk, those are bread and butter banking issues. They're quite vulnerable to risk, to shocks, and they didn't take the actions necessary to meet that.
That was day one for Michael Barr, the Federal Reserve Vice Chair for Supervision. Day two on Capitol Hill is coming right up. Some news just crossed on the Bloomberg moments ago. Work with me here and I'll read you the statement. This comes from the Senate Finance Committee Chairman, Ron Wyden, who says the following. We today released the findings of a 2-year investigation into Swiss bank Credit Suisse's compliance with its 2014 plea agreement with the U.S. Department of Justice for enabling tax evasion by thousands of wealthy U.S. individuals. The committee goes on to say the investigation uncovered major violations of that plea agreement, including a previously unknown, ongoing, and potentially criminal conspiracy involving the failure to disclose nearly $100 million in secret offshore accounts belonging to a single family of American taxpayers. Tom, that's the latest on Credit Suisse.
We made light of it coming out of the last block into air. There's nothing light about this memo. I want to make clear this is not only about the headline of Credit Suisse, but other smaller Swiss banks. And John, this goes back to not the arrogance, that's completely the wrong word, but the insular nature of what was done in Geneva in 1713. That's how far back this goes. We're the Swiss. We're different. This is the way we do it. There's the emotion of World War II and all that. Real emotion there and documented. But this is an insular, unique part of Swiss society that Wyden's going after.
So that's some deep history. Let's do the more recent history.
Yeah.
We spent the last couple of weeks talking about the lessons learned by regulators through the financial crisis and applying those lessons to right now. Lisa and I remember on the Sunday evening when this deal happened, we talked about the lessons learned by the banks themselves. Jamie Dimon of JP Morgan, think about the problems he inherited when they took over Bear and they thought they were doing the government and a financial system a favour. That's why this government guarantee of the Swiss, Lisa, was so important to UBS, because when you take over a bank like this with the problems it's had, an environment like this one, you can inherit these kind of problems.
You want a big credit line and you want a backstop to those losses. I will also argue that this also gives some sense to why Sergio Ermotti was brought back, because he dealt with the 2008 legacy law cases that they ended up dealing with the Justice Department and many others. He has been through this rodeo before. He will know how to navigate it.
UBS, Tom, and Swiss trading is positive still by about 1.8%.
There we are with the news of Credit Suisse. We'll continue to monitor that. And, of course, Washington will have, you'll see that tonight with Anne-Marie Horton and Joe Matthew on Balance of Power. Right now, the balance of power shifts to Providence, Rhode Island. Wendy Schiller, absolutely definitive at Brown University on American history. Wendy, when you watch these hearings in the ballet and the political posturing, how close are we to the debate that Andrew Jackson led in the 19th century? We've been doing this, not for decades, we've been doing this for centuries, this distrust of fancy people on Wall Street.
Yeah, Tom, we can go back to Thomas Jefferson and Alexander Hamilton, right? I mean, their big fights really centered around the role of private industry, private economy. How much should the government subsidize, incur debt, backstop debt? This was all Alexander Hamilton versus Thomas Jefferson at the very beginning. And in the end, Alexander Hamilton won and Jefferson lost, in the sense that we did have a centralization of financial power, and we do have government backstop of debt, as we've seen, or bad mistakes, let's just say. And, you know, Ron Wyden, Senator Wyden's, you know, it's not an accident this is coming out today, because the Democrats really need to show that in other realms, they're going after rich people. They're going after banks that mess up, right? So this is not an accident this is coming out today, as I just said, because the Democrats really are in trouble here in some ways, right? And many Democrats, are more than a few, voted with the deregulation or the loosening of regulations in 2018 under the Trump administration for banks like SVB. And, you know, this is a problem for them. They can go after, you know, somewhat the banks, but on the other hand, they allowed this, you know, or they participated in the deregulation. And so now that, and they're the administration now that has to clean it up.
Wendy, it's clearly documented the Swiss people are livid over the Swiss failures in banking here. Bring it to the present. Are the American people engaged, not so much in these hearings, but in the debate about our collapsed financial system centered around two collapsed banks?
Well, I think the American people, are starting to think that government just doesn't work on any dimension. We've seen they can't keep us safe. They can't keep our money safe. We just went through this. And when I say we, there are the vast majority of Americans remember the Great Recession and the banking crisis. It's not that long ago. So this just compounds the sort of distrust and lack of faith in the federal government. And if you are a party that believes in government, like the Democrats, that's a real political problem for you when you're in charge.
Yesterday, there was a lot of finger pointing at the Federal Reserve and their lack of really enforcing some of what they saw at Silicon Valley Bank, at least in the U.S. side of things. What is the policy implication of some of that finger pointing?
Well, Lisa, that's a fantastic point, because we have a sort of quasi-private massive bank overseeing other banks. It's not a really ideal system for enforcement and regulation. And, Elizabeth Warren will call for the Federal Reserve to do something, or the executive branch. But at the end of the day, Congress has to redo or pass another law. And then regulations have to be issued. And we all know regulations can be influenced by lobbying or court cases. So it's a long road to actually beefing up enforcement. In the end of the day, the simple picture is that the federal government did not properly oversee what this bank was doing and didn't stop them before it was too late.
Let's say that they do successfully shunt the blame over to the Federal Reserve, as they're trying to do, and basically the lack of oversight there. This is my question. Then what? Does this basically remove some of the independence of the Federal Reserve? Does this call for some sort of increased scrutiny or increased muscle? I mean, what is the natural step with respect to some of that criticism?
Well, Lisa, this is where you have to go to the power of the banking and investment industry, particularly in terms of campaign contributions and lobbying, very powerful forces and voices, and say, listen, don't blame us for the laziness or the carelessness or the greed of one bank or two banks. The rest of us, especially the big banks, we do what we're supposed to do. So I think what the American public might veer towards is sort of giving bigger banks. They trust them more. They seem to be stable. The government bailed them out already once. Maybe giving them more power in the system, which would, of course, we know would be very bad for regional lending. So I think this is a case where the federal government, meaning the Biden administration, has to pick a side. Are you going to try to intervene and control the Fed? Trump actually tried to control the Fed, and some might say he did in terms of interest rates. So that's the big question mark. Do you try to exert more control but then fail again? And that's the puzzle for the Democrats.
The irony of this is not lost on a lot of people, that basically we have gone from emphasizing a decentralization of banking to now the big banks are better and the bigger the better. I mean, can you give a sense of the potential political read-through of that?
Well, I think, again, it's one more layer, I think, of government, or one more layer of sort of people feeling, disempowered, that they have to go to the big bank. Those restrictions might be hard. They may not know the banker they're dealing with. It may be just on the phone with somebody they never met. Closing regional branches, which big banks seem to be doing. These are all ways in which the average American feels less connected. And if you start to feel less connected to the economic system, Alexander Hamilton said this, you will then feel less connected to the political system. So it causes problems not just for the economy, but also for the democracy.
Hey, Wendy, wonderful to hear from you and tie those things together. Wendy Schiller there of Brown University. Let's just pause on a couple of things. So we get this headline 10, 15 minutes ago that Credit Suisse is still evading tax evasion. That's the allegation from a US Senate panel. Just work through it a little bit further. Let's say, and I don't know where this ends up, but just think it through. This ends up with a massive fine from the US government on Credit Suisse, which ultimately, in practice, is just a sovereign wealth transfer from Switzerland to the United States. Can you imagine how messy, depending on the size of that fine, if we get one, how messy that's going to look?
You mean in terms of basically international warfare?
The Swiss government has to pony up the money to pay the US fines for Credit Suisse?
The politics on both sides of this are going to be really interesting. On one hand, it's almost like a carte blanche to go out there and basically bring all your legal claims, because people know that there are some seeds that are underneath the covers here that people are concerned about. On the other hand, you're right. What does that do for international relations?
I want to point out, we don't need to go into the dirt of it now, just keep the show moving forward. But this is a quite detailed memo, and this has individual names in it. And I will say this is an amateur, not on a legal basis, John, tangible allegations against unnamed and named individuals, including employees of Credit Suisse. This is not some press release contrived by whatever party. This is a real document.
Well, that's Credit Suisse, and we'll deal with the Credit Suisse UBS news a little bit later. Of course, the latest, if you are just tuning in, welcome to the programme. Sergio Ermotti, the former UBS boss, is now the UBS boss again. We'll get into that. And day 2 on Capitol Hill for Michael Barr, the Vice Chair of Supervision over at the Federal Reserve. Then to do so's coming up from Federated Hermes, with equity futures doing nicely this morning. We're doing okay, up 8 or 0.9% on the S&P, and the bond market, a rally, yields lower by 5 basis points. The 2-year 4%, the 10-year 3.55.
This year has all been about the whipsaw.
We don't think rates are going to continue to fall right here. We think we're going to see them turn around.
We're not in that camp that we're expecting the Fed to turn so quickly.
I think the market is possibly getting ahead of itself in terms of pricing cuts.
Could there be rate cuts coming in 2024? Sure, right? But we think there's going to be one more hike this summer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The new guy, UBS, is the old guy. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro.
Oh.
Equity futures doing okay this Wednesday morning, up by almost 0.9% on the S&P 500. TK Sergio Ermotti is back.
There was, and you and I felt the same way. We saw the headline as we were greeting the morning, and we're like, why didn't we think of that 5 days ago? It's so obvious, and what's particularly important for me here, as we mentioned in the last hour, Sean Patrick Barnett there with great coverage from Frankfurt. This is cultural, and it's domestic. Yes, it's about wealth management. Yes, it's about IB. Forget about it. It's about a nation livid. They went with the boy from Ticino.
And they've gone for the guy from Lugano, as you said it. Yeah, the Swiss man
Do you
is
like
back.
how I pronounce that?
I like that. You
Zoe
practiced that this morning.
No,
Nice.
no.
Did you make the calls to
Zoe
Switzerland?
Schneeweiss from Zurich. I said, Zoe, help me here. How do you is it Ticino, whatever?
Well, it's
Nailed
not
it.
just that he's Swiss, Lisa. As Tom pointed out, he's got experience running UBS, and he's got experience winding down investment banks and making them smaller.
And he's got experience with a lot of legal problems, because there were a lot of legal problems along the way in the post-crisis era, and he's going to be dealing with them on all sides of the Atlantic, as we learned this morning from the U.S., coming out with some scathing allegations about tax evasion for UBS, not out of the woods, and yet now they have somebody with ample experience and a backstop from the Swiss government to handle it.
Can't escape the trouble, even though the entity's been taken over. Seemingly the headlines just keep coming, the hits keep coming. Lisa, the headline from the U.S. Senate panel about 30 minutes ago, if you are just tuning in, Lisa reads as follows: Credit Suisse is still aiding tax evasion. That's the allegation.
And UBS has to stomach it because they're assuming Credit Suisse and all of their obligations. Again, though, ultimately, to your point, John, and it's a really good point, won't the Swiss government ultimately be basically backstopping any fine they have to pay the U.S.?
It depends how big it is, if it's big enough, because I know there's some tearing here about when the state guarantee kicks in. But ultimately, if it's big enough, Tom, it's a sovereign wealth transfer, isn't it? Aren't they on the hook for this stuff?
I'm not going to get myself in trouble there, but I am going to agree with you. There's a tiered agreement here, but I'm not sure we know those details. The one number I've seen, and please, folks, don't quote me on this, 170 billion seems to be what the people of Switzerland are into for the collapse of 3 big banks going back 30 years, then 2 big banks going back 30 years. This model's working out.
Nice.
And then 1 big bank going back 30 years. And it's 170 billion large is one statistic.
So this was 2 weekends ago. The weekend before that, the US had its own troubles. We heard from the Vice Chair of Supervision at the Federal Reserve yesterday in front of the Senate. We hear from him in front of the House a little bit later. Lisa, based on what you heard yesterday, what do you want to hear today?
Do they back what Wendy Schiller was just saying? Is this basically a time to emphasize the big banks and say that regional banks really either need much stricter oversight, higher fees, or need to be consolidated and made bigger? I mean, ultimately, isn't that the conclusion that we've gotten?
More regulation? Not just that. Where was the enforcement? Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
That's the key question.
And this is my problem right now. When we talk about more regulation, they had oversight. They knew there were problems. There were obvious problems that were flagged. Michael Barr said that he was aware of them as early as February. I mean, probably earlier than that. So at a certain point, what are we talking about here? And I think that you raised that well.
John and I have had a beverage of our choice, very expensive, at the bottom of St. James Street in London. And there's a statue out on the street of a guy who said, overcome by events. They were overcome. All of what you guys just said is true. And John, you nailed it with the idea, why didn't they do something? It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Do you think it's unfortunate that the Vice Chair of Supervision, Michael Barr, is the guy that's taken the heat from this, Lisa, and not the former guy? And I'd go one step further, not the current guy, the Chair of the Federal Reserve as well?
I would strongly agree that I want to hear from Randy Quarles. I want to understand what was happening with him with respect to how some of the regulations were loosened or whether enforcement was de-emphasized. That's really what I want to understand, perhaps more than Michael Barr.
And the Fed chair,
who is also overseeing a lot of that. Yes, that's correct. And I think that that's the reason why people are pointing fingers at the Federal Reserve and questioning what this impact will be on the credibility of an agency that's tasked with a very difficult decision right now.
Here's the price action in the moment, up 0.9% on the S&P 500. In the bond market, yields are lower by a couple of basis points. Let's call this 355 on a 10-year. On a 2-year, Tom, let's call it 4%. We're down about 4 or 5 basis points at the front end.
My single data point, John's got to be where we've been the last 3 days, where you were interviewing with the Tots for the coaching job, and that's 4.03% 2-year. We really haven't had that 2-year breakout to a new higher yield regime from the shock of 3.76%.
Can you imagine if I left to run a football club, Tom? How would you feel about that, really?
I'd grow my beard and be standing right next to you there going, ooh!
That moment that, like Nate.
Do you like Ted Lasso, the new season?
I haven't started watching it yet. Is it good?
By consensus among people smarter than me, the last episode was the single best episode ever.
So Nate is at West Ham, is that right?
Do you know who's joining the
squad?
Is he
at West Ham? Who's joining?
Nate's at West Ham, but he's out of the plot. Who's joining is, I think it's Zava, who's patterned after the guy at AC Milan, Ibrahimovic.
Ibra, yeah.
Ibra was in the show last week as a new guy, a fictional guy
really?
Who's joining, who's a prima donna.
And he's older.
He's older, and he's
okay.
old. That's the plot going
so
forward.
So now AC Milan is basically Richmond FC.
But finally you'll get into it because AC Milan shows up to save the day.
Lisa, we'll pick up on that over the weekend, I guess.
I have no idea what you guys were just talking about 100%. 10 a.m. I'll tell you what I'm looking at right now. At 10 a.m. we get day 2 of the hearings in Washington, D.C. Fed and Treasury officials are testifying again before a House committee about Silicon Valley Bank. We're going to hear from Michael Barr, the current head of the Vice Chair for Supervision for the Federal Reserve, Martin Grunberg of the FDIC, and Nellie Liang of the U.S. Treasury Department. Do they come out with some sort of prescription for how they should oversee this? Do they talk about the importance of banks getting bigger? The irony, more than a decade after the financial crisis, of looking to make banks bigger. 10 a.m. we also get pending home sales. The data points that maybe don't matter. I think this does matter because when you start to see rates coming in, people buying bonds, there is this question of, okay, that brings down mortgage rates. Game on. Everybody go back to the market. Is that what we're going to see in a plateauing of some of the declines in prices and some of the gains that we're seeing in the number of sales?
And Lisa, great chart you selected there. For those of you on radio, basically it's the crater of year-over-year real estate. Lisa, I think a lot of people aren't aware we've come near the zero bound on year-over-year gain.
And yes, that is absolutely true. And now the question is, what from here? I mean, how much more pain is there? And perhaps we'll hear some of that today. Speakers at the National Association for the Business Economics unit over in Washington, D.C. are incredible. It is an incredible lineup. Rich Clarida, the former Fed Vice Chair, as well as Catherine Mann of the Bank of England, Seth Carpenter of Morgan Stanley, Tobias Adrian, Isabel Schnabel. Incredible lineup at a time when so many people have a very unclear sense of both Fed policy, ECB policy, as well as the path for inflation, John.
Bramo, thanks for that. Looking forward to those speakers through today. I understand Mike McKee's going to make it down there at some point as well, so we get some reporting from him too. Joining us now is Linda Dussel, the Senior VP and Senior Equity Strategist at Federated Hermes. Linda, I want to start with this. What is special about 4,000 points on the S&P 500? And what do you make of this struggle since November to break out more than 5% in either direction, up or down?
Well, good morning. Thanks for having me. I would say that 4,000 S&P is not nearly as important a psychological number as maybe 30,000 Dow has been historically. I think we've gotten past that. Well, what we haven't gotten past is technicals, and technicians are really over. They're on top of all this stuff all the time. And I keep reading about the technical levels through which the S&P needs to pass, as you suggested, a very tight range for quite some time. I think it's something like where we open now, 46 or 40, 36, 40, 40, something like that. We're at the high end of what has been a tight range. The 200-day moving average is something that is watched very, very closely. And that's not just for the market, but for individual names and sectors to let us know. I think technicals and technicians are very much involved these days. It's not so much a psychological number anymore, but a level. 200-day moving average, big one, 50-day moving average.
Linda, there's such respect for the long-term view of federated Irmas, and I want to go back to something I haven't looked at in ages, which is the market drawdown from the peak of what seems ages ago. I was shocked, Linda. I didn't know this. Standard & Poor's negative 70%, down negative 11%, NASDAQ negative 24%. On the day-to-day grind at Federated, are we still in a bear market? And how are you positioning given the duration of this bear market?
Well, we are still in a bear market, and it's gone on for quite a long time, but we are now in a range-bound area. And it sounds so boring to continue to say that we're in a neutral space right now. So we'd like to get up over the old highs, and we think it's going to be a number of years delayed because of the pickle that we find ourselves in now, that the Fed got in the way and they started to raise rates dramatically. And when they raised rates dramatically, then that messed something out over in the banking area. And, that's what happens when you rock the boat as much as what we have. So we still do remain mired in this bear market. And all we've seen last year was a 25% pullback, which is garden variety. And so we're wondering if maybe we deserve more than that with the mess that we're in right now.
Does it make sense to you, Linda, that we've seen this incredible rally in bonds and in stocks, that people are pricing in fewer rate hikes and possibly rate cuts, and they're also pricing in a very strong economy?
Well, I think it goes to something that you were saying probably just a few moments ago, which is that if the market itself doesn't look like it's getting hit that hard, you're having rolling recessions underneath, and there's still so very, very much liquidity out there, not just with traders, but also with individual investors that aren't married to anything right now. And they say, well, I see that they crush tech stocks. Let's go run after tech stocks, and right now they seem to have run after tech stocks. And so in recent days, we've hit energy hard. Let's go run after energy. So what did we do last year? We hit stocks and bonds. And so let's go ahead and run after them both, because we have, last number I saw, almost $2 trillion of cash on the sidelines. We prepared for the recession. It's just not here yet.
Linda, have you ever gone for a drink with Lisa? I think you'd both have a great time.
I think so. I love that. That was so much fun.
Linda Dussel there, a Federated Hermes. Bramo, you talked about the wisdom of crowds last week, or lack thereof. I think Linda's speaking to some of that right there.
I love it. Just basically, I picture, little cartoon characters running after ech sector, like, no one's gotten those for a while. Let's go over here. That's sort of what it feels like, a rolling ball of money kind of just going into different sectors.
But in the literature, you have rotation. But I don't understand how you have rotation given the broad dynamics of the fixed income market now. It's just too unstable.
I think that word rotation, Tom, is kind of the sophisticated way of making it sound,
It's the washing machine when you're surfing and you get just basically sucked into the waves.
You can't do that where the move index
We're rotating.
Again and again.
It makes it sound sensible, doesn't it? There's real purpose and reason behind a lot of it.
Well, that's a different story.
Lee Ferridge of State Street in the next hour. Looking forward to that. Equities up 0.8%. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Swiss banker Sergio Ermotti is returning to the role he had for 9 years. Ermotti will once again be CEO of UBS to oversee that complicated acquisition of Credit Suisse. He is replacing Ralph Hamers, who's been CEO for just over 2 years. Ermotti will take over after next week's annual general meeting. Hamers will stay at UBS for the transition period. Meanwhile, a U.S. Senate committee says that Credit Suisse is still helping rich Americans hide assets from the IRS. That's almost a decade after one of the bank's units pleaded guilty to tax evasion conspiracy. According to a new report, Credit Suisse worked with dual citizens to conceal assets from tax authorities. The bank says it does not tolerate tax evasion. Now, Ukraine's President Volodymyr Zelensky is warning that a Russian victory in the city of Bakhmut could be perilous. He told the Associated Press that Moscow could then build international support for a deal that would force Ukraine to make unacceptable compromises. Zelensky has also invited China's President Xi Jinping to visit, despite China's ties with Russia. Now, the CEO of Macy's, Jeff Gennett, will retire in February after 7 years of leading the department store. He'll be succeeded by Tony Spring, who serves as the president of Macy's and CEO of the company's high-end Bloomingdale's chain. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Leanne Gerrans, and this is Bloomberg.
UBS has named interim chief executive Sergio Ermotti to take the job permanently.
Sergio Ermotti has got to do three big things. He's got to convince the shareholders that he's got to control risk. He's got a grasp of what's going on in the investment bank. He's got to bolster wealth management and reduce leverage.
Bloomberg's been speaking to the new boss of UBS, Sergio Ermotti.
Sergio, great to have you with us today on Bloomberg. Sergio Ermotti. Sergio Ermotti.
Sergio Ermotti, welcome to Bloomberg, sir. The best quarterly profits since 2010.
On each occasion when we've sat down with Sergio Ermotti, he's had a great numbers story to tell. You're 3 years into this. Give yourself a mark out of 10. How have you done?
It's Christmas time, so I'm gonna be very generous with myself. So I give a lucky number, 8.
Orchel is gone. Zellner is gone. Are you all in and committed to this bank going forward? What do you want to say to the market today?
Well, of course, I'm committed.
Sergio Ermotti, welcome to Bloomberg. Your final set of results after 9 years at UBS.
Just amazing, fantastic work.
That was
from our colleagues
superb.
in
Who
London.
was the
Wasn't
guy
that great?
in the middle of it? He looked like Guy Johnson,
Guy
but
Johnson,
I wasn't sure that was.
Francine Lacqua, Manus
Oh,
Cranny.
my
Just
word, well
fantastic
done.
work
Really
covering
good.
Sergio
Yeah.
Ermotti for the best part of a decade. And the news this morning, if you are just tuning in, Ermotti is back at UBS, Tom, taking a helm of the combined entity of UBS and Credit Suisse. What a turnaround.
And that is the span of a turnaround. When this bank, UBS, Union Bank of Switzerland, SBC and Union Bank of Switzerland, bailed out by the Swiss government in 2008, and Ermotti parachutes in, I'm going to guess 2-3 years after that, and that's where you begin to see the Bloomberg coverage of this guy that came from Merrill, then from UniCredit, and over to the GFC post-UBS.
The understanding that sort of is implied in all of those years, and the oldness of the 2011 videos, which is sort of shocking because it wasn't that long ago. But this question of the historical institutional knowledge of managing through a crisis and managing different cultures. And that, I think, really is highlighted by this person.
UBS right now is up by about 2%. We'll cover that story for you through the whole of today on Bloomberg TV and on Bloomberg Radio. Equity futures positive by about 0.8% on the S&P 500. That's the Swiss story of this morning. We have to deal with the US banking story as well. US regulators, including the US Vice Chair of Supervision of the Federal Reserve, Mr. Barr, Tom, in front of the Senate yesterday, in front of the House a little bit later.
Yes, the hearings there are tangible, but now overlaid by what we saw this morning from the gentleman from Oregon, Wyden. I mean, this thing is an overlay. How do you avoid that at these hearings today?
Pretty tense stuff, Tom, to read that headline, that the committee's investigation uncovered major violations of a plea agreement made back in 2014.
Bunch of distractions in Washington. Let's get to it. She is with Balance of Power. And, of course, our chief Washington correspondent, Amory Horton, joins us this morning. Amory, is there any implication or linkage of these hearings into the Wyden release this morning? I was stunned by the fiery language in that release.
It was fiery language, and if I could just bring you some of it, he calls them greedy Swiss bankers, quote, who appear to be engaged in, this is the quote, massive ongoing conspiracy to help ultra-wealthy U.S. citizens to evade taxes and rip off their fellow Americans. I mean, at some point, potentially, this can be brought up in the hearings today. But, of course, these hearings are about the collapse of 3 U.S. mid-sized banks, and they're going to be asking the regulators what happened. Yesterday, it was clear from the regulators, especially from Vice Chair of Supervision Michael Barr, that this was mismanagement. But at the same time, you did see these lawmakers say to the regulators, if you knew that there was issues at these banks, why didn't you step in? I think the quote was from Senator John Tester of Montana, a Democrat, and he said it was clear the regulators knew what was going on, but no one put the hammer down. And there's going to be a lot of that today.
Was there a cohesive target for lawmakers' anger? And I ask this because we're talking about the potential to crack down on smaller banks, and then they're talking about larger banks having issues, while at the same time pushing a lot of people toward larger banks that have withstood some of the stress in the U.S.
Lisa, the words Congress and cohesive rarely belong in the same sentence, and that is not happening right now. There is potentially one area where you see lawmakers from both sides of the aisle want to have a discussion, and that's about raising the FDIC cap. But besides that, you have Republicans who are blaming quote-unquote woke banks, that was part of the problem. They blame the higher aggressive interest rates from the Fed because of inflation, which they say was induced by the Biden administration. And then you have Democrats, which this was on full display yesterday with Senator Elizabeth Warren, talking about the rollback of Dodd-Frank in 2018. But remember, even some Democrats voted for that.
Emery Horton, I'm going to digress here from the hearings front and center for the Bloomberg world to Axios' report last night of Chris Christie of New Jersey saying flat out he'll never support President Trump again. It dovetails with what Greg Valliere wrote about this morning, which is the likelihood, the weight, W-A-I-T, or maybe the weight, W-E-I-G-H-T, of a third-party candidate for president. Is it too early to begin talking about this?
About a third-party candidate?
Yeah,
yes.
third
I mean,
party?
it's too early, I think, in Americans' progress as a country. People have tried this before. It hasn't worked. But what is interesting is potentially you're going to start to see a little bit more of a bigger divide. Obviously, the former president has about a 30% hold on this party, and it's very difficult for anyone who wants this, difficult for someone in the Republican Party who want to try to separate themselves from him to gain the remainder support. But the race, it is still way too early. But at some point, there could potentially be a front runner. At the moment, it's interesting to hear about Chris Christie, because at the moment, obviously, when you hear from the former president, he thinks it's going to be Governor DeSantis, because that is the individual he continues to attack.
Emery, I'd love your opinion on this because you've done so much reporting from Europe. I think for our international Bloomberg surveillance audience, it's so odd that America only has a two-party system and not more of a mishmash like everybody else has. With your travels, why are we relegated to a two-party system versus a multiple-party system?
Well, we don't have a parliament, which I think John as well has talked about a lot on this program. So it's one party rules all for how the American system works. It's not that you have to set up coalitions. We've seen in the past in America, obviously, independents try to have these third-party bids. And yes, that names have... Yeah, well, they make a name for themselves, but it is incredibly impossible. I mean, people like Senator Joe Manchin. There's been reports that maybe he would run as an independent in 2024. Wow. But this stuff, this is very, very, very unlikely.
You liking this, John? I mean, this is just like
not really.
It's like American civics.
I mean, I'd rather get back to the news if we can. So AMH yesterday in front of the Senate, today in front of the House. What was left out yesterday that you think needs to be covered with these supervisors, the U.S. regulators later?
Well, I think one thing that potentially is interesting, and maybe we're going to get Fed Chair, Vice Chair Michael Barr talk about, is there is a bipartisan bill being introduced by these two individuals that you don't see names together a lot, Senator Elizabeth Warner and Senator Rick Scott of Florida. And this is about an inspector general at the Fed, and they say that instead of the Fed governors anointing who this person should be on the Fed board, it should be the president, and then the Senate confirmation hearing. So I think maybe you're going to see a little bit more heat put at these regulators and their supervision of the banks today. Remember, things are always a little bit more rowdy in the House than they are in the Senate. But at the end of the day, and a congresswoman told us yesterday, a former congresswoman, Stephanie Murphy, told us on Balance of Power, remember, and she's been in these hearings are literally only about promoting performative actions for individuals to run on, less about getting to the nitty-gritty details.
YouTube clips for their constituents.
No.
You know, it's often the case. Anne-Marie said rowdy. I mean, I think some people would say about the House maybe less focused than the Senate when these hearings take place.
Yeah, but she's the host of Balance of Power. She's got some leeway there. She can do that.
You got something to add there, Lisa?
Nope, I'm good. No,
I'll keep digging.
Well, this is the issue, is that, it's whack-a-mole of anger. It's sort of trying to figure out where to put anger today, and then basically to get people riled up, and there just isn't cohesion on how to do that.
Let me get in front of my April plea that John hears once a month at the beginning of the month. Can we just have the British system where the campaign is shorter? That would just help everything.
Well, it's not. I've heard an argument for it that it gives you time to shine a light on the candidate in a way that maybe other systems don't. I don't know how convinced you are of that, Lisa.
Well, I just think that I'm just curious about that Long Island congressman right now, currently.
How'd that work out?
I mean, there was a lot of vetting time. I don't know. I'm just saying, theoretically, what are we doing here?
Equity futures on the S&P. Up 8 or 9/10 of 1%. Yields lower by a couple of basis points, 355. It's day 2 on Capitol Hill. For the Vice Chair of Supervision, Michael Barr, a little bit later. morning to you on a Wednesday. It's Remember the Day of the Week. Struggling with that at the moment. Equity futures up on the S&P, on the Nasdaq too. Grinding higher by 0.8% on the S&P 500. On the Russell up by more than 1%. The small caps doing nicely. In the bond market, all over the place through the week so far. Just going through the week on a US 2-year. What were we up 20 basis points, up 8, all over the place, and now down 6, down 2? Make your mind up, Lisa.
I don't understand the 2-year. The 2-year is giving me angst. Honestly, at this point, are we pricing in rate cuts? Are we pricing in disinflation? Are we pricing in some sort of financial crisis? And if so, when are stocks going to wake up?
Ask me in 5 minutes.
Okay, thanks.
Down 23, or rather up 23 on Monday, up 8 yesterday, and down 3 this morning.
Don't you guys have the feeling like you take the surveillance nap, or we're just waking up, or whatever? You don't know what's going to greet you on the cell phone.
Which is why
you pick up the phone and it's like a mystery. If you go to the Bloomberg Terminal app, you just don't know what's going to greet you right now.
There is a sense at the moment, Tom, that no news is good news. Without a doubt. The fact that we didn't have to spend another weekend talking about failed banks.
Hallelujah.
An improvement, and maybe that explains more than anything why the 2-year yield was high Monday morning.
So then why is it lower today? I mean, honestly, it's hard to explain. Is this basically people stopping out shorts and then hedge funds going into long
What has your
treasuries?
spread market done? I mean, some of this is learned by quality bonds and by high yield. Are they cooperating with a recovery to norm?
Depends which. I mean, we heard it from Brian Weinstein. He's loading the boat with respect to senior bank bonds of top-rated banks, and you have to wonder if others are doing the same.
Back to something like 500 basis points over on high-yield spreads. About a month ago, that was something like 390. So we've had a break of 4, 5, and then back down again.
We got a busy section here, but I'm going to bring this up for 30 seconds. I'm reading a lot about commercial real estate. I'm trying to get smarter.
What are you learning?
I'm learning that it's beginning to affect Class A property. It's an assumption BC is weak. And I'm beginning to learn that there's a lack of transparency of what it means for, off the top of my head, 200 banks. It's not about J.P. Morgan or Bank of America.
I'm learning that the pain that everyone's saying is going to come is going to affect a lot of other institutions, and people are examining which institutions are heavily invested in some of this debt. And I think that that's really the key that people are looking at right now.
We can't get away from the banks, can we?
No.
Because
really
no, well said, yeah.
That's been the
issue. Do you want to talk about the banks?
You want to do more?
Touch on the banks,
let's talk about UBS. Okay, let me talk about UBS, right? So they are acquiring Credit Suisse. We did hear about the Senate Finance Committee coming out with some pretty explosive language this morning. Those shares up 2.7%, at least those, the American Depository Receipts. I want to bring you this. UBS's chair recently said, we have to let everybody go through a culture filter to make sure that we do not import something into our ecosystem that causes issues. So I'm glad that I'm not being filtered through a culture filter. But
did he elaborate on that? What is
he
that?
He basically was talking about not wanting to create something bad from the virulent elements
the other
of
one's
Credit
toxic.
Suisse. That sounds like what he's
John,
saying.
2 hours ago, I copied and pasted that out of a German newspaper headline because I didn't understand the German, and it was the culture filter thing.
I'm not sure. I want to really think about this, and I'm not sure what I would feel if I were a Credit Suisse employee that knew that I was going to be going through a culture filter.
You've got to be super careful about language like that.
Yeah.
On a lot of levels.
Like super careful.
I think we should send Ferro
on a lot of levels.
Lisa,
my frustration with that, and I've gone back and forth on this over the last several weeks, we all know some supremely talented people that have worked at Credit Suisse for a long, long time. If you're talking about management, name them. Don't sit there and tell the whole workforce that they need to go through a culture filter.
I couldn't agree more. Don't taint an entire group of people, a lot of whom are really excellent, with some sort of negative brush that they're lesser than coming into our organization.
I think, Lisa, we got to send John to Zurich. I mean, that's others.
The other,
just want to get rid of me to Zurich.
Let's also talk about expensive yoga pants because I enjoy them. Lululemon shares are jumping this morning ahead of the opening bell. They reported earnings that were better than expected yesterday, talking about how their full-year sales will grow about 15%. To $9.3 billion versus the $9.1 billion that people had been expecting. People still really enjoy yoga pants. I'm just saying, theoretically, some people even
You're talking about yourself again. Are these your stock picks for you?
My stock picks. And then Micron. And I just want to let you know.
No, they're not, Tom. They're really not.
Micron, we've seen a really rough run, and there's been a big question of when is the bottom in semiconductors. And it seems like perhaps the worst is over, and that's why you're seeing a lot of semiconductor shares up, but particularly Micron, which reported earnings yesterday, 2.4% gain, talking about bigger than expected sales in the fiscal third quarter. quarter, again, have we cleared out inventories? Are we beginning fresh? And can people start going into some of those areas that were beaten up last year?
Bring up that board again. On radio, it's real simple. It's a list of the stocks that Lisa kills every morning. And I really like the idea that you dovetailed Lululemon with Micron, which is the thickness of Lululemon cloth, from what I could tell. I like how you did that. Lululemon and Micron. That was brilliant.
Would you like another word on Lulu? Or are you
I think I'm good, but I just want to say this. I'm so glad we're not just putting up 5 bank stocks every morning. I actually really enjoy that we're looking at other companies and other corporate stories.
And the VIX under 20 is important, 19.25.
The president says it's over. Just so you know, it's settled down.
And he's buying Lulu pants, too.
It's good.
Just kidding.
Can we continue here? Stumbling through a Wednesday, Edward Al-Husseini joins us right now, senior interest rate strategist at Columbia Threadneedle, and really being in the news with a nice write-up, I believe, in the FT recently. And I'm going to cut to the chase. And you nailed this working in international economics at Harvard years ago. So much about these moments and these crises is fear of making a mistake. That invades monetary policy, including Martin Wolf's wonderful essay today. What are we afraid of making as a mistake in our new central bank policy?
Yeah, and it's difficult because you're balancing 3 different elements. You don't know what's going on with inflation. You don't know how quickly monetary policy is filtering into the real economy. And now you don't know what's happening with the banking sector and the extent to which that's going to affect growth and inflation down the line. And you have to prioritize these unknowns. Inevitably, in my mind, the Fed's going to prioritize inflation.
They have to prioritize inflation. We've got a dual mandate. Maybe we have a triple mandate, as Steve Roach invented, talking about financial stability. Can financial stability weigh in on a May 3rd Fed meeting debate?
Very unlikely. In my mind, they've done a really good job of separating the two, at least on paper. In practice, more than anything, they've been lucky in the sense that this particular banking crisis hasn't spiraled into credit markets. So I think they can take comfort in the fact that the liquidity facilities they put in, what the FDIC has done, that's ring-fenced some of the issues, at least at this point. And again, when they get to the May meeting, it's more likely than not that they'll be able to refocus on inflation once again.
Does it make sense to you that we've priced in at one point almost 100 basis points of rate cuts by early next year? We've retraced that a little bit, but not that much.
It's been very violent. It's been exceptionally violent, right? So we went from, a peak rate of, 5.7 and the Fed on hold in the second half of the year just 3 weeks ago to now the Fed entering an aggressive easing cycle in the second half. Which scenario is most appropriate to the data? I would say something that's closer to a hold. But now that the banking system genie's out of the bottle, it's exceptionally difficult to price out an easing cycle and a recession being brought forward. And that's what markets are really struggling with.
So here's the dissonance. Risk assets are rallying, perhaps because you're seeing perhaps a slower pace of rate hikes or rate cuts. Does this make sense if the only way that we get that is with the pain that comes with some sort of either crisis or massive credit tightening?
Yeah, it's been interesting. Risk, again, to some extent is reflecting 2 things in my mind. One, the underlying strength of the economy and the underlying strength of corporate balance sheets is still with us. That's something we entered the year with. We've talked to that, at length. And it's been one of the frustrations for the Fed. The other thing is interest rate volatility, which exploded in the course of the past couple of weeks, is starting to cool down, particularly in the longer part of the curve. That's a positive backdrop for risk assets. We see it, let's say, in investment grade markets starting to open up. Not quite so primary markets in high yield. So it's a different degree of tension that's priced across risk and rates at this point. I would expect those 2 stories to connect in the coming months.
If the Fed does cut rates as the market's pricing in, do you start to get less constructive on 10-year treasuries, which you have been perhaps overweight?
We like them. I mean, look, if the Fed cuts, one of the things that the last couple of weeks has illustrated to us is that treasuries once again play a very, very effective role as a buffer against risk. That negative correlation between rates and risk returned in the course of the past 3 weeks as people sought a safe haven asset in the face of heightened recession risk. That's fantastic. So if the Fed's cutting, they are seeing something on the horizon that's disinflationary, that's bringing down inflation, that's potentially bringing down growth. That's a really good story for treasuries. We can argue about where you want to be on the curve in that kind of environment, but you want to be long duration and long interest rate risk in that environment.
Hey, Ed, great to catch up as always. And Al Husseini there of Columbia Threadneedle. Ed, thank you. I can't believe how long the month of March has felt. You've still got a few more days. And Ed mentioned there where the 2 years been over the last month or so. The high, the intraday high, 5.08%, March 8th. The intraday low, 355, March 24th. Yeah. So you've got an intraday low of 355, a high of 5.08%, and a couple of weeks separating them, Tom. We've gone from no landing boom, Chairman Powell's talking maybe 50, to disinflationary bust. They're going to start cutting interest rates by what, Lisa? 100 basis points?
Almost 100 basis points, yes.
In what, a number of weeks? 2-3 weeks?
Well, that's the broader view, and I think you nail the framework of it great, but it's even a more narrow view of looking 2, 3, 4 days. I wasn't even aware that early this morning we had a 4.1154% 2-year yield. So there's not only the broader volatility you talk about, there's almost an intraday cacophony to it.
Well, Ed talked about the violence of the Fed rate hiking expectations and rate cutting expectations. And just to give you a sense of how violent it was, on March 8th, when you saw that high, that intraday high, you saw a Fed funds rate anticipated to be almost 5.5% or more than 5.5% by year end. Now we're pricing in a 4% handle, perhaps even lower by then. So here we're talking about a massive shift in perception and monetary response that's getting priced into the market.
So that's senior loan officer survey that we get.
May 8th.
May 8th. You're ready, aren't you?
Oh, yeah.
When that comes out, if you don't see exceptional tightening, tightening in that, and you've gone a few weeks without another bank failure, are we going back to the old story? How long before we do that?
This is the reason why I wonder if there's a risk for 10-year treasuries. I wonder if there's a risk for inflation expectations, especially if the Fed does go ahead and doesn't cut rates, or doesn't hike rates, going forward, doesn't necessarily get more hawkish.
When we're all together, she can frame her gloom better. It's a better gloom when you and I are together.
This is a more exceptional gloom?
It's a more clearer and...
A more polished gloom?
Clarified, polished.
It's a polished gloom.
Posh
more
as well.
depressing gloom.
It's a very posh gloom.
It's a polished gloom.
Distilled gloom.
I hear Tom Michaud's going to join us later, the CEO at KBW. We'll do that at about 8:30 Eastern Time, so let's call it 50 minutes from now. Equity futures up 8 or 0.9%. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. UBS is going back to the future. Sergio Ermotti is returning to the bank of chief officer to oversee the acquisition of Credit Suisse. Ermotti will replace Ralph Hamers, who has been in charge for just over 2 years. He'll retake the role he held for 9 years after the annual general meeting happening next week. Now, President Joe Biden and House Speaker Kevin McCarthy exchanged dueling letters in a fight over raising the debt ceiling. McCarthy is demanding that negotiations begin on a series of spending cuts and regulatory changes. The president responded by challenging Republicans to produce a public budget plan. Now, President Biden is urging Israel's Prime Minister Benjamin Netanyahu to reach a compromise on his controversial plan to overhaul the courts. The proposal has sparked protests across Israel. The president told reporters, quote, they cannot continue down this road. Vladimir Putin's drive to expand Russia's armed forces is adding to labor shortages. The war in Ukraine has drawn hundreds of thousands of workers into the military from other sectors of the economy. Government data suggests a net increase in Russian military last year of approximately 400,000. That comes at a time when unemployment is at a record low. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
Clearly, I think markets are feeling relatively relieved. We are seeing, obviously, markets repricing the degree of Fed tightening. It's too early to say that the Fed should be cutting this year, but I think the recalibration in terms of the terminal rate in the US, I think, is relevant.
That was Jeremy Stretch there, the CIBC head of G10 FX strategy. Philip Lane of the ECB spoke this morning, the chief economist, in an interview, and he said, we expect these tensions will settle down, more hikes will be needed. They often refer to their baseline view. It's like saying, well, this is what we think is going to happen, might not happen, but if it happens, this is what we think we're going to do. And ultimately, the baseline is this will settle down, and Tom, they're going to keep hiking.
We need to talk about this for 30 seconds. We got Mandeep coming on, but this is really, really important. Are we still in an inflationary worry, or can we look as Torsten Slok is looking at disinflationary vectors? Professor Lane is saying, no, we have an inflationary worry.
We have an inflationary worry. There is a thought here in the US that maybe we have a dirty disinflationary solution,
listen to you.
Given what's happening in the banking system. And it's not happening in quite the same way in Europe, Lisa, and maybe that's the important distinction.
Remember when we used to talk about the transmission mechanism of financial markets, and now we don't care anymore if there's sort of some sort of decline in yields and stocks go up, then that's a good thing for the economy? Well, I think that probably the ECB feels a little different, because I'm looking at German two-year yields at 2.6%, down from a high on March 8th of 3.33%. So they keep saying, we're going to hike more, we're going to hike more. And bond traders keep saying, no, you're not, no, you're not, no, you're not. And it's basically consistent. So the more they talk, the more people just say, you guys don't know what's going on.
The US issue, though, has sort of evolved in a subtle way. It's no longer just about the price of money. It's about the standards around through which the money will be lent, Tom, at that price. That's a difference. And I think that's what we're looking for in the data on what day?
May 8th, yes,
just to
correct.
see how much they've tightened things up. It's not about whether I can get a loan now for 4 versus 5 or 6 previously. It's whether I can actually get a loan at 4 or whether I'm declined because people don't like my credit profile or something like that. Whatever.
I don't know. And
Sure.
again, we mentioned the commercial bank overlay, the commercial real estate overlay, I should say, later, and that's got to get out to announcements from May 8th. We're going to digress right now, and this is going to be a lot of fun. Mandeep Singh with us now, of course, senior technology analyst at Bloomberg Intelligence, and he lived, and I knew of the oddity. No, all semiconductor research in America did not come out of San Francisco, Palo Alto, and on down south. It came out of Boise, Idaho. And long ago and far away, potato money in Boise, Idaho, invented and supported Micron. They reported yesterday, maybe the great unknown of the semiconductor business. I want to get to the metaverse, Mandeep, but very simply here on Micron, who are those guys and why was that news yesterday important?
Well, so Micron is the bellwether when it comes to semiconductors, simply because memory typically bottoms first. When you're talking about trough in a semi-cycle, memory tends to bottom first. And they gave some encouraging news around incremental demand getting better. I think where we still have unknowns is how quickly will the PCs and the smartphone market rebound, because half of Micron's revenue is PCs and smartphones. Yes, data center is strong, autos is strong, but that's not the big revenue generator right now for Micron. And so I do think they talked about, cutting CapEx, so that will bring the market to an equilibrium in terms of the inventory that they are carrying. And they wrote down a lot of the inventory, which is why they had negative gross margins. But clearly, I think there is lack of demand, especially on that device side. And that was something not clear on the call.
Mandeep, I'm going to segue here from semis, potatoes, over to the metaverse. I thought Paul Kodrowski was brilliant yesterday in the Twitterverse, talking about the death of the metaverse and when Facebook renames itself back to Facebook instead of Meta. How close are we to the death of the metaverse?
I think based on, Meta shifting to an era of efficiency, it clearly suggests they are focused more on the revenue generating aspects of their business, which is really focusing on ads and, the core feeds and the video ads business. And I think metaverse is still a 2030 thing. What I'm yet to see from Meta is, just cutting back on spending when it comes to the CapEx side of the equation. They're still very aggressive when it comes to CapEx spend on building the metaverse. And probably they will cut back because there's nothing on the horizon that suggests you can monetize the thing right now.
Mandeep, let's put these two ideas together. This question of Meta unable or unwilling to really invest significantly in capital expenditures. And at the same time, the likes of Micron and NVIDIA count on that type of capital expenditure by large businesses in order to really grow what they do. So how much is Micron, okay, yes, they might have beat pretty low expectations, but how much are they seeing, or are you expecting to see the potential consequence of declines in capital expenditures?
Well, so Micron themselves are cutting CapEx, which is going to impact the semi-cap equipment guys. So clearly there is a chain in terms of, who spends what in terms of CapEx and how it impacts the customers and suppliers. And in this case, I think with Meta, the good thing they have is they are using a lot of that CapEx spend in terms of developing their AI capabilities. Now, a lot of AI and large language models go into their core business as well in terms of what they can do, with regards to showing more personalized ads and offsetting some of that Apple changes that really was a big pricing headwind. So not all of that CapEx is going towards metaverse, but a large chunk is. And so that will have a trickle-down impact on NVIDIA and all the chip names, because that was one of the biggest drivers. You're right. Their customers, the chip customers, are very concentrated. It's the hyperscale cloud guys. If they're paring back on CapEx, that will have an impact.
I'm looking right now at some of the gains, and they're pretty incredible. NVIDIA shares are up more than 130% since the low in October. Does this all make sense to you, the incredible rally in semiconductors, basically off of, potentially extremely dire expectations last year?
Yeah, so I go back to my comment that I made earlier that they trough at different times. And so definitely memory seems to have troughed. You can't say the same about, the overall chip market, because autos and data center spend has held very strong. These guys haven't even seen a slowdown, forget about a trough. But on the PC and smartphone side, I do think we are close to a trough. And that's why the more diversified you are as a chip company, the better off you are, which is what we are seeing with some of those companies, NVIDIA, AMD, et cetera.
Hey, Mandeep, thank you, sir. As always, Mandeep Singh there of Bloomberg Intelligence. Lisa, like you, the first thing I thought when these numbers came out after the close yesterday, okay, don't care about that company. What's the macro read? Yeah. What's the story here for the economy?
Obviously. That's really my question is basically, are you starting to see more capital expenditures? Are you starting to see people, basically people saying, we've bottomed out here. We can go ahead and buy more PCs and more, computer devices for our children that maybe have already broken all the ones we bought during the pandemic.
Okay, and whether personal again.
I'm just saying this could be a story people are going to.
So think about how the year started. China's reopening. Story's going to change. Reflation, problematic for the US. How much has that changed? I mean, I've barely heard about the China reopening story at all over the last couple of weeks. The story's just kind of gone quiet as commodities rolled over.
And we've seen perhaps data that also is disappointing in terms of how quickly they've gotten back up to speed.
Yeah, Win Thin was brilliant on this a couple days ago. And Dr. Thin of Brown Brothers Harriman made clear that we're looking at it in a prism of trade in China's international development. And what they really need is a domestic recovery. And they're seeing that domestic recovery. And it's so regimented there in terms of manufacturing and labor processes, it takes time. So maybe we'll see that domestic recovery, and then maybe you see Australia do better, in the stereotype.
So we've gone from bank cuts, recession, to no landing, lots of rate hikes.
It's a narrative of the day,
and now all of a sudden it's rate cuts again and disinflationary bust.
Correct.
Am I right?
It's basically.
And where's it going to be in 2 months?
Well, I will tell you.
Or tomorrow.
Exactly.
5 minutes.
Wait, so hold on a second. I have a serious question for you.
Sure.
Are you ready to write your March 31st year ahead outlook? Do you feel like you're in a better position now?
I've got a couple of days, haven't I?
Okay, but do you feel like you're in a better position now than at the beginning of the year?
I'm definitely in a better position now than at the beginning of the year.
Punt. Yeah,
I'd put that outlook now. I'd rather put that outlook out now than 3 months ago.
The bar is pretty low. I mean, come on.
Super low.
But John, while you were gone, I went to levels. S&P 4,000. Dow 200 points from 33,000. NASDAQ is I never thought I'd say this, nearing 13,000. The levels shot within our numbness of crisis. These equity levels, I think, are stark. They don't scream bear market. They
futures
scream,
right
wow.
now are doing better, up 0.9 on the Nasdaq. Coming up next, Lee Ferridge of State Street is going to join us very shortly with an equity market that keeps improving by the minute, near session highs.
The Fed narrative is certainly an uncertain one in the context of those long and variable lags in terms of policy.
I think that they can just take a pause in that rate hiking cycle.
Depending on what analyst you talk to, it could be anywhere from 25 to 100 basis points of rate hikes that they have seen because of the crisis that's kind of now built in.
I think at the end of the day, what the Fed feels relatively confident about is they can handle what's going on in this situation.
I don't know that we need to fear the current rate regime.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Crisis over on a Wednesday. Coming up on claims tomorrow. That will be interesting. All three of us together today on radio and on television. And John, for me, the headline item off the data, which speaks to the healing over the trauma, all the great coverage you and Lisa did there with the Fed show and the Sunday special and that. You know what? We had a 4.11% two-year yield for a cup of coffee early this morning. It screams a little bit of calm.
We need to go to the calendar. April 7th, payrolls, no one cares. April 12th, CPI, seemingly no one cares.
Yeah.
April 13th, First Republic reports earnings. Then you go to April 14th and you get earnings from JP Morgan. I think there's a decent argument to make here that the earnings from the banks and the guidance they give us is perhaps more important than the incoming information. So when the Federal Reserve says, and Lisa and I talked about this repeatedly last week, when they say we're data dependent on what data now, given the developments of the last couple of weeks?
Absolutely brilliant. I missed that because I was having a three-island tour. And the answer is, John, Diamond's going to speak. Diamond, through that press conference, is going to give his opinion. And this is about deposit flows in and out, the dynamics of money market funds. Is that data more important to Chairman Powell now than the macroeconomic data Mike McKee follows every day?
And as Lisa mentioned, it's no longer just about the price of money. It's about the lending standards around the price of money and how much they tighten, Lisa, in the weeks to come.
I do wonder, though, if JP Morgan's really representative, if there's a divergence really opening up here between some of the smaller, the regional banks that perhaps are seeing more stress and constraining lending more at a time when the JP Morgans of the world don't see the same sort of stress in their business. In other words, which data, which viewpoint are we going to really understand the microeconomics that are going to underpin the next leg of this cycle?
I mean, Schwab with some challenges here. That's been in the press. But is Fidelity the JP Morgan of money market funds? I'm asking that. I don't know. I don't know the answer to that. But money market funds play into this.
The incredible surge of cash into money market funds will also be something that a lot of people will be looking at, because where is that money coming from? Is it just sort of a rearranging of bank deposits from smaller banks into money markets? Is this going from risk assets? Is this basically sort of de facto credit tightening as seen through these flows? These are sort of some of the things people are trying to dig beneath the surface.
John, what do you see in the bond market?
Now?
Are you looking at German yields? Or are you looking at, I'm looking at the 2-year, but is there a nuance there?
I'm just thinking of the range we've seen through the month of March. And we keep glossing over it and sort of running to the new bright thing and the next narrative, the next regime shift. We've gone from 355 at the low, 5.08% at the high in a couple of weeks, and now we're at 4%. Yeah. And there's a lot of people comfortable now with the idea that this is it. Last 2 weeks, disinflationary bust, rate cuts are coming. I remember 3 weeks ago when this was it, no landing, they've got to do more to try and get that landing. And Lisa, they're going to go maybe to 6%.
Jan Hatzius over at Goldman Sachs saying what a lot of people have been basically trying to say, which is basically that the banking stress does increase the chance of recession, but it is not, as he said, the economic hurricane that a lot of people are expecting, and that he only expects a 35% chance of recession this year. If that's the case, two things. Number one, does that mean that the Fed still cuts rates in response to the banking stress? And is that what enables the U.S. economy to avoid that stress? And number two, does that really mean that it's risk on, or does that mean that inflation is going to remain a lot longer, a lot higher? And that's really, to me, those two tensions.
So there's two different decisions here, and the market behaves like there's only one. The Federal Reserve makes the decision to pause, and then they make a separate decision to cut. The market decides that pause is the start of the cuts. They just think that it's the same process, ultimately. I think for the Fed to stop and then just stop is a very different story to the Fed that starts to go on this massive cutting cycle. You mentioned Wei Li of BlackRock earlier in the week, and you and I talked about that this morning. She's pointed this out at BlackRock. We're reaching for the old playbook, just like that already. First sign of stress. When we've spent the last 12 months saying the Fed put us gone, the story's changed, and if we get into trouble, maybe they pause. But that doesn't mean they cut all the way back to 3, to 2, to 1, and who knows next. We'll see, Tom, but this is about the reaction of the Fed and whether we are truly in a new regime, given where inflation is.
Even in crisis, they're data dependent. It's about labor. I mentioned claims earlier tomorrow, getting it out to some quote-unquote normal number. And the other is, do we begin to see any form of disinflationary ebb in services, as, say, Torsten Slok at Apollo or David Rosenberg at his own shop in Toronto are talking about? And to me, that's the heart of it. John, we got to look at this data because it's more correlated today, optimistically, than anything we've seen. I'm going to start, John. Oil, $74 American.
No banking crisis, no news on that, and good news for this market. For now, equities up by 0.8%. I think the president came in yesterday. The president said a couple of things yesterday, and when he says things like, it's not over yet, I'd never advise that. Usually they say we've got it under control. The president also said that things were settling down. They're settling down, and that's hard to disagree with based on the lack of news in the last week. I mentioned equities up by 0.8%. If we can get back to that board, I'll go to foreign exchange just briefly. This story about the divergence that could emerge between the ECB and the Federal Reserve. Where does that leave euro dollar right now, Tom? 108.50.
Yeah, well, it's a nice little lift up there. These are some of the tweaks that tea leaves were looking at. Someone doing that as well with decades of experience. We lean forward for Lee Farage, head of macro strategy for North America. It's State Street. I love Lee, the Farage sarcasm, the bank crisis. It should be over. I just love that as well. You've seen a few of these, unlike me. When you see a bank crisis, how do you know when it ends?
You don't know. You don't know when it ends. It's just time. You know, time is the greatest healer, Tom. And look, another day, no more bad news on the banking side. Increasingly, it does look like this is not a systemic problem. This is idiosyncratic. You know, a couple of banks we've seen, we know about over the last couple of weeks, but really, you know, since Sunday before last, things have started to calm down. And the fact is, if this is it, which increasingly looks like it is, then we do need to go back to the thinking about the Fed of a few weeks ago. We do need to go back to looking at the data and saying, well, okay, so what's really changed? There's going to be some tightening in lending standards. There's going to be some pullback in lending. We know that. But how much? How much if this is it? And we're done here in terms of the banking crisis for now. The Fed can't rely on some big pullback in lending in order to do the job on inflation. They have to carry on doing what they're doing.
So, Lee, people believe that the Fed is in the business of breaking things because they have a history of breaking things. The Fed believes they're in the business of risk management. So given the risk they've got to manage and the information they'll have between the start of May and now, do you think they'll get sufficient information to make the call to hike interest rates?
Yes, I do. On the basis that if between now and May, we have no more continuation of the banking crisis, the data continues to be strong, which every indication is it will, then that's enough. Yes, that's enough for them to hike again in May. Assuming nothing, you know, we don't break anything else in the banking sector, then yeah, why wouldn't they go in May? Don't forget, it was 3 weeks ago that Powell spoke to Congress. And right then we were pricing a terminal rate of 5.7%. We had year-end rates at the end of this year at 5.5%. We're now at 4.90 terminal and 4.20 at the end of the year. But if this has been contained to what we've seen so far, does that really change the environment that much?
But Lee, you actually are expert at understanding the dynamics, the technical underpinnings of a market that has whipsawed up and down and been incredibly volatile, the most volatile that we've seen since 2008. So how vulnerable is this particular fundamental ecosystem to some sort of shock where the Fed says, you guys are wrong, we've been telling you this, and we're going to hike rates, and guess what? We're seeing something different than you are.
Look, we had some very volatile days, for sure we did. But the system overall stood up. It was volatile, but it stood up. And let's be honest, we have, you know, we've got 5 weeks of messaging here that's going to come through. We've already seen, look, last week we had 115 basis points of cuts priced in by the end of this year. We're now at around 60. So we've already seen some sort of repricing. Nothing's broken. We've repriced a bit. Everything's working sort of pretty well. So, you know, can we reprice more from here? Yeah, absolutely. We won't get back to where we were on March the 8th, not anytime soon, but there's room for rates to move back higher, I think. Again, we have to assume that we're not going to see any more on the banking side.
And John, with your travels here, I mean, we do have Lee Farage on the line right now.
What would you like to ask?
We've got to talk about the unimaginable.
What's that?
My favorite Liverpool is the guy that goes right for the net, mental.
Mo Salah.
Salah. Could he actually leave and go to Spain as ESPN is writing about?
I mean, I was going to ask Lee about the equity market, but why don't you ask Lee?
I mean, Lee, help us here. John and I are designed to know, is this the breakup of your beloved Liverpool?
Been breaking up for a little while, Tom. Sadio went last year. Mo's still there. He signed a new contract. I think Mo will stay.
Okay.
I don't think he's going to go to Spain. He'll stay.
You miss Mane, don't you?
Do miss Mane.
I think you miss him a lot.
Last time I was on, you asked my prediction for Liverpool, Real Madrid, and I told you 2-0 to Liverpool. I was right for 18 minutes. Then we lost 5-2.
Hey, Lee, that was great. Lee Ferry stay street. Lee, thank you. He was right for about 18 minutes or something.
This is, I don't even understand what we're talking about there, but the answer is...
Well, thanks for bringing it up.
No, but I'm bringing this up because so much of our audience cares about this on radio and television. Boy. But, John, help me here. The 4 teams... It really matters if you come in 4th in the Premier League,
to play
right?
Champions League football, yeah.
And Liverpool's not doing that, and so these hitters are like, we're out.
Well, they might make it. Spurs are struggling. It's going to be a competition with Newcastle and maybe a couple of others as well.
But Liverpool is
They should
out.
be up there. But then what's happening with John Henry and the business? What's happening with Fenway Sports? And
we'll have to see about
what happens with Liverpool. Wasn't there a sale and now there's not a sale? He can't get his price.
It's a partial sale, is it? I mean, it's very partial, sort of.
I think it's interesting, Tom, that people as sharp as the Glazers, as Henry, for instance, may be looking to exit. I just wonder what that says about the valuations in football at the moment. But
we'll have to see.
We can do that another day.
I got 3 emails just here in 10 seconds. Thanks for the football talk.
Yeah.
Where's it been?
Where's the equity market talk was my message. But
really?
Another time.
We're up big. We're up a stick.
We're up 0.8%. Mark McCormick at TD joining us shortly.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Swiss banker Sergio Ermotti is returning to the role he had for 9 years. Ermotti will once again be the CEO of UBS to oversee the complicated acquisition of Credit Suisse. He is replacing Ralph Hamers, who has been CEO for just over 2 years. Ermotti will take over after next week's annual general meeting. Hamers will stay at UBS for a transition period. Meanwhile, a US Senate committee says that Credit Suisse is still helping rich Americans hide assets from the IRS. That is almost a decade after one of the bank's units pleaded guilty to tax evasion conspiracy. According to a new report, Credit Suisse worked with dual citizens to conceal assets from tax authorities. The bank says it does not tolerate a tax evasion. Ukraine's President Volodymyr Zelensky is warning that a Russian victory in the city of Bakhmut could be perilous. He told the Associated Press that Moscow could then build international support for a deal that would force Ukraine to make unacceptable compromises. Zelensky has also invited China's President Xi Jinping to visit, despite China's ties with Russia. Now, the CEO of Macy's, Jeff Gennette, will retire in February after 7 years of leading the department store. He'll be succeeded by Tony Spring, who serves as president of Macy's and CEO of the company's high-end Bloomingdale's chain. Gennette has led Macy's through a turnaround plan, which included shop closures and new store formats, job cuts, and also a focus on digital offerings. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
Look, this is a banking crisis, but the reason, I think we're calling it that, I guess, at this point. But the reason we got there is very different than a lot of other banking crises. It wasn't because of bad assets, right? It was because of duration, really, more than anything. There will be eventual impact in terms of, okay, if banks are lending less, that has to have an impact on corporate America.
That was Brad Rogoff, the Barclays head of FICC research, amongst other things. Tom, you can sense the nervousness there around calling it what it is, a banking crisis. And one thing that's come up over the last 24 hours after that testimony from the Vice Chair of Supervision of the Fed, Michael Barr, is the speed at which some of this happened. And Lisa, there was this reference to this number. 100 billion was about to go out the door of SVB on Friday. And everyone's talking about the age of digital banking, and I totally understand it. I think it's a valid conversation, it's important. But when it comes to SVB, the speed was a reflection of the character of the deposit base. Lisa, it wasn't just the speed that broke things. It was the character, the nature, the concentration of the deposit base that led people to see how quickly things played out.
The digital aspect was the reason why we didn't see people in line waiting to get the deposits out of the teller's window. And that's really the key distinction here. But it isn't a sort of necessarily the reason why all of these deposits were withdrawn. And that is to your point. When there are problems with the oversight, when there's problems with the risk management, then you have problems with people not wanting to put their money there. It's not rocket science.
Well, to make it even more simple, Tom, there's a difference between a small number of big hands and a big number of small hands.
Yes.
And if it's a small number of big hands, you can move 100 billion just like that. That's the reflection of things. And the speed was just a reflection, at least for me, Tom.
You're killing me.
The speed was a reflection of that.
You're going to get me in so much trouble here. I said this, and I had to be put in a timeout chair by a number of our listeners and viewers. Is SVB a bank?
Well, you and I had an argument about this a number of weeks ago.
It's
a bank. It's just a different kind of institution.
It's a new kind of entrepreneurial bank without interest rate discipline is about where I want to be right now. I mean, it's just as simple as
I know that, Lean. If you're on radio, it's amazing.
You catch it on the Bramo cam. We've got sensors on the Bramo cam where a red light goes
sit here
on.
in the middle trying to read body language. And reading Bramo's just brilliant because when Lisa's got something to say, she leans away from the mic when she's got something to say. That means she's really got something to say when she leans back.
I'm trying to restrain myself. Thank you for
And then
pointing it
leans
out.
back in. Here we go. Go.
No, I was just going to say, how many other banks are there that are not banks, but really are banks and that are going to fail? I mean, I wonder about that with Signature. It was tied to commercial real estate. It's got all of these other institutions. So how many are wrapped in that kind of wrapper? And then people put their money in thinking that it's just a regular bank, and it's not. That's the point, is that if you have that concentration risk, suddenly you've got systemic risk, suddenly you have concerns, and it gets painted with a broad brush throughout the financial institution.
We're on the same page, yeah. I'm with you.
It'll be interesting to see. And again, these hearings today. Look for balance of power tonight. What time is it? 10 p.m.?
5 p.m. I still don't think that's actually what you wanted to say. I think it was
No,
something.
it isn't. We're still getting a lean here.
Move on.
It'll come.
My bow tie is a disaster today. Saving us, Mark McCormick, Global FX Strategy Head at TD Securities. Mark, how do you write a research report given this chaos?
You stick with the weeklies, you stick with short-term ideas, but you do kind of link it to some of these broader themes that I think are still prevalent that we've talked about a few times already. Like while there's a focus on the shock to the U.S. banking system, it does take us back to old Fed research, which I think is very, very powerful right now, that there's two different R-stars. The financial sector has one, the real economy has one, they're competing. And now we know that the financial R-star is more important for policy. So the other side of it is also there are guardrails to the slowing global economy because China is still coming from through the reopening. Right. It's still accelerating. And so what you have is the FX market is actually kind of clear that this is still being treated as a U.S. shock. Mm-hmm. And this is bad for the dollar in that context, given the guardrails you have around the global economy and the global growth outlook.
I got 8 ways to go here, Mark, but I'm going to get out front of our IMF coverage, folks, which you're going to see over the next couple weeks. I'm looking at some idiosyncratic emerging market tensions, perhaps off a U.S. banking crisis, perhaps off the mystery of central banker to the world, Jerome Powell. What do you see in EM, particularly when I see the blue dollar in Argentina popping out near 400 pesos? These are little tea leaves, aren't they?
Yeah, so I think you have your standard playbook, which is kind of like which currencies have big vulnerabilities on the credit side, which ones basically those vulnerabilities show up in terms of dollar liquidity, and they basically show up in the current account. So you kind of want to dust off the playbook where there's stress coming from the U.S. and which countries are going to have the repatriation coming back into U.S. assets, which is purely a function of the current account. So you kind of have your good EM, your OK EM, and your bad EM. So your Turkey, your Argentina, those currencies are basically still not kind of in the lexicon where I think a lot of people trade them as kind of an EM group. But I think more of the orbit is really kind of thinking how LATAM relative to Asia works in this, because Asia is insulated from this crisis very well. And I think on the other side, LATAM, something particularly like MEX, is something that's very connected to the U.S. growth stories, connected to the Fed outlook. And that's something that's been a very, very, very focused carry trade, which could be vulnerable in this over the next 6 months if the Fed does start to cut.
I think of the dollar as a wrecking ball. It sort of drives through all of these neat narratives that people put out there and then checks them and is unpredictable. And we've seen this weakening, this great weakening, as people price in rate cuts through the end of this year. If Lee Farage is right, and basically the Fed's going to say, The banking crisis never happened. It's over. It's not going to have a material impact. We're looking at data that's still hot. We're going to hike rates. And we're going to go back to the estimates that we were talking about 3 weeks ago. What does that do to the wrecking ball of the dollar?
Well, it's a great question because you kind of need to think like what happens over the next 3 months and what happens over the next year. I think particularly our view is one where if you look at the correlations, the dollar is much more correlated to rate cuts in the future versus rate hikes right now. I would also stress that when we run like a global macro vol gauge that includes rates, equities, and currencies, the dollar's already trading a premium there. So if you do get what we anticipate as well as a couple more hikes, which are kind of fine tuning, which are a bit more cautious, but the bigger move is for a rate cut cycle to begin next year. Your regime in your yield curve changes. We move from bear flatteners, which is super bullish for the dollar, to something that could be bull steepeners, which as an aggregate is very bearish for the dollar. And again, we still have the rest of the world outperforming the U.S. So if you get more Fed hikes and you get the idiosyncratic weakness in the U.S. that comes with it, you also have U.S. equities underperforming. So when you layer in the factors that matter for FX, it's rates, it's terms of trade, it's equities now. And those are things that are very important that we see in our framework that tells us what's driving FX performance. So I'd say, yes, if you get the fine tuning of the Fed the way we're characterizing it, the dollar is generally a bit, it's a bit more two-way. Euro caps out at 110. Dollar yen probably peaks around 134. But the next big move in the next 3 to 6 months after that is for the start of a more sustained dollar bear market.
How significant is that? How deep do you see that bear market being?
It can be quite substantial if you look at in terms of valuations and as you mentioned on EM, if we get to the end of the Fed cycle and we're very close to the terminal rate, rates volatility will collapse. Our models already show that rates volatility is expensive relative to macro factors. So you take that out, you get the rotation of capital flows out of U.S. equities into other assets, particularly in Europe and Asia, and you see a push into emerging markets, particularly carry, the high quality carry. And you see a shift to Asia-based growth currencies. Like right now, we like the Korean won. So if you put that all in context, you could see probably at least a 5 to 10% move lower in the broad dollar next year.
Mark, are we missing a piece of this? What happened to the slide to the other side of the dollar smile? What happened to that piece of the whole process?
Well, I think there's two components you have to think about it. So the one side of the dollar smile is the world kind of moves into a full sustained crisis. And the other side is U.S. exceptionalism. What we're doing is we're losing the U.S. exceptionalism piece. If this is a U.S.-centric banking crisis or turmoil or shock, which forces the Fed to change policy because the R-stars are more focused on financial stability than inflation, and if this shock is disinflationary, given the change in credit standards and lending standards and a broader slowdown in the U.S., you lose the U.S. outperformance on that smile. And the other side of it, if this doesn't morph into a global crisis, again, this is not impacting Asia. We are closely tracking banking sector stocks. Biggest drawdown we see is in the U.S. banking sector. Outperformance, what we see is in the European banking sector. Yep. Eurodollar should be trading at 112 right now off of relative bank performance. So you're losing both extremes of the smile. I'd say that obviously the bigger one is that this could morph into a global pullback, but that is not our base case.
Interesting.
So we could lean there, but most likely this is U.S. underperformance.
We're like hanging out in the middle of the two extremes at the moment, at least. Mark McCormick at TD said it was about rate differentials and then basically said it was about bank differentials.
It's bank stocks. Basically, that's the data we're watching.
Bank stocks.
It's literally where we're at.
It's nuts. Priya Misra and more in the next hour of Bloomberg TV.
Bloomberg Surveillance, good morning, everyone, on a Wednesday. Claims tomorrow is of interest to me to see if we get any kind of glimmer on a perfectly employed America. Lisa Abramowicz and Tom Keene here with better data here. Lisa, let's just look at the data here quickly. I think we've been on top of it all morning, but the bottom line is you walk in, I set up a stick, somebody says, what's that? That's up 1%. And there have been moments here where NASDAQ 100 this morning up 1%.
Ball of money. People see that things have sold and they say, okay, game on, let's go into them. I mean, basically, people want markets to go up. That seems to be the theme. The interesting thing to me is that you see yields down, people going into bonds and people going into stocks. Everything is green. Let's go. And it's perhaps the absence of news that's giving them that sense.
What we're going to do on this right now, and it's so important, we're going to get right to it. If you are part of global Wall Street, this is the point where you stop on radio, on television, and you listen. In this banking crisis, you need somebody that is so knowledgeable on it. And at Middlebury College a few years ago, studied back the 10 banking crisis back to Jackson. That would be Thomas Michaud. Thomas Michaud is CEO of KBW. We're thrilled he could join us this morning here. Within the crisis perspective as well, how's the week been? What's the biggest sweat this week for you on a day-to-day grind?
Well, first of all, it's been nonstop. You really can't have markets work and economy work if the banking system's not working. And it's a step beyond that because it creates a lack of confidence. You mentioned earlier about a history of bank panics. You can argue whether it was 8, 9, or 10, but let's say roughly 10 bank panics in the history of the United States. It's not, it is, look, banks made mistakes. We just had the second and third largest bank failure in American history. But the banking industry is built on confidence. And when confidence is shaken, it could absolutely impact the whole economy.
1831, National Bank of Middlebury. A perfect example of a small bank going, wait, they're going to come in here, cash out, and give it to James Dimon? Explain to us the dynamic right now of the national banks of Middlebury out there scared stiff of those top 5 banks.
So first of all, it's not only National Bank of Middlebury, which actually is a bank that you mentioned specifically, but the big banks lead the global banking system. This is an industry where the American big banks lead the global financial system. That's number one. But it's really the mid-sized banks that I think we need to talk about. And if let's just say for round numbers, the big banks today have 60% of the deposits in America. They do not make 60% of the loans to middle America and small America. So if the deposits are going to the big banks, but they're not the ones making the loans to middle and small America, it's going to have an impact on the economy. And I think long term down the road, we're not going to be in a good place. But the last thing is you would say, why is that happening, Tom? Because there's this implicit guarantee that banks can be too big to fail. We just saw it with Credit Suisse. There was really no worry that counterparties of Credit Suisse weren't going to be made whole. And if that is the sense of the land, it's going to drive business away from these mid-sized banks, and I think is going to have a detrimental effect on the economy.
So why haven't the steps that the FDIC, that the Federal Reserve, that the Treasury Department already have taken to basically de facto ensure all deposits for most mid-sized banks been enough to really garner that support that they're backstopped to?
We got close, Lisa, but we didn't go the distance. So Secretary Yellen, when she spoke, still left the door open between implicit and explicit. And look, if you saw what the first reaction was of the FDIC with Silicon Valley, it was to give certificates, not deposits money back. So I think that actually accelerated the outflows of banks on that Friday. And I think what we need is orderliness. My preference would be if the administration came out right now and said, we're going to use our authorities and we're going to say that any bank that fails of any size for the next year, we're going to guarantee the deposits while we figure this out. I think it would be very good for the economy.
Putting longstanding solutions aside for a minute, you talked about how a lot of these smaller banks punch above their weight when it comes to lending. How much have you actually heard of tightening of lending standards, of actually retracing some of the loans that some of these regional banks have been making?
It's going to be the story of the second half of 2023 that is happening. It was happening before we had the recent bank run. It was happening before that. And I'll tell you that story. As soon as COVID started, the first thing that happened over 24 months was about $5 trillion of deposits came into the banking system. We had 13 trillion go to 18. Never in my career have I seen the deposit system grow that quickly. That was the COVID relief and the stimulus coming into the system. Mm-hmm. It's now being drained as a purposeful part of our policy. So we are probably, according to our numbers, still 10% too high in terms of surge COVID deposits. So the industry's sort of fighting two competitive elements. Number one is FDIC deposits are shrinking as a part of government policy. That's going to be a tightening effect in the economy. And then number two, we have this confidence, which is a little bit shaken, which, by the way, it's gotten better. I want to make sure it's gotten better, but it's still shaken. And that is driving deposit flows too. So it's really turmoil in the economy, which is going to slow the economy.
Keep talking, you're lifting the 2-year yield. I got bad news, Thomas showed for you. You're not the most important person at Keefe, Bruyette & Woods. Jade Rahmani is. Right now, when you look at commercial real estate and his work in mortgages, and your security analyst, what you guys are known for decades at KBW, Jade Rahmani is the guy on what's going to happen with commercial real estate. What's he telling you when you call him?
So about a month ago, we came out with this call because the other thing is this banking issue is not just the banking. It's not specific just to banks. What we're dealing with is when interest rates go up this fast, there are implications, and there will be other implications. So we wrote a report about a month ago that Jade led the author, your good memory, Tom, and he said basically he thinks there's 30% downside in office buildings in major markets around the country, with about half of that due to the cap rates and about half of it due just to factors of other factors around occupancy and inflation. You're already seeing it. This is a more slow motion event. It's going to take 2 years to play out, but that's the next asset class.
What's it mean for global Wall Street? What's it mean? I'm selfish here. What's it mean for the people on Manhattan, including Bramo? And what's it mean critically for our viewers and listeners if we're going to see a 30% negative?
I just think it's going to impact economic growth. And I think it'll just mean that we're not going to have in my opinion, I think that will be a headwind for economic growth as all the industries adjust around that. And it is going to cause banks to tighten their lending criteria, which in and of itself is a big form of quasi-quantitative
Lisa, you see this in
tightening.
car loans right now. I mean, I'm reading about it percolating in. You can't go out, this is a general statement, you can't go out and get an auto loan now because they're tightening up.
Yeah, I think there was something like the lending that a lot of them have been rejected, Tom.
But don't remember, too, we just came through a period where zero interest rates was the rocket fuel for shadow banking. So, and now we're gonna dial that back somewhat, too, in my opinion, which will be an effect for slower growth.
There's a confluence of a lot of different factors here, and teasing out all of the different interconnected pieces can be tough. I want to go back to something that you said, that we're still about 10% elevated when it comes to the deposits, the cash sort of awash in the banking system, and you talked about how that's going to get withdrawn and that's going to have a sort of accelerating tightening feature to the economy. Is that deposit base going to disproportionately leave those regional banks? In other words, it might be 10% of overall deposits, but a much greater portion of just the specific smaller and mid-sized banks, given the consolidation of deposits in some of the big behemoths?
It actually was going to leave the bigger banks more because they're bigger. So, for example, our estimate is roughly $60 billion, I think we were going to see come out of J.P. Morgan this quarter. And now it'll be less because of this remixing. But even Jamie Dimon's been in his calls talking about the fact that he saw hundreds of billions of dollars of shrinkage in his deposits. But I don't want to alarm anybody by that because the industry has been planning for that and knew that that was going to happen. And remember, when we talk about it, what is that? Well, that's the Fed shrinking the money supply. It's also depositors buying treasury bonds because they yield more rather than bank deposits. That's cash sorting. So I think it's navigable, but if we put a crisis around it, it just makes it trickier.
Given the likely increase in flows out of some of these deposits, given commercial real estate and the stress there, given the shadow banking system and potential fractures that people are expecting there, do you think that this banking crisis is over?
I think every day that goes by, we're getting more stability. I think Washington wants it to stop. I think barring any other major shocks, I think it's behind us and that we can now deal with some of the more challenged institutions. But also, too, if we had more time and I laid out the statistics of Silicon Valley, it was off the charts on a couple of risk measures.
Yeah, no
I mean, off the charts.
Yeah.
And remember, we have 4,700 banks in the United States.
Right.
2 of them have failed spectacularly and quite large. So we're not underestimating the impact
I got
of it.
8 ways to go here. I got time for one question. Somebody emails in here, and this was an honor to play at Middlebury years ago when Wendell Forbes was coaching. When in God's name is Middlebury going D1 hockey? They were born to play D1 ECAC hockey. When does this happen? You're in charge.
Middlebury's good, and I got to tell you, now baseball's made a run at Middlebury, but when I played baseball, we got our fans when they walked past the field to go watch lacrosse. But now
That's always the way.
baseball's standing.
The lacrosse
I'm looking
studs
to
get
baseball.
all the visibility. When do you guys go D1 hockey? It was made to happen.
I would support that. We've got a great
There
team.
we go.
And
That's the
thank you.
news we need to have today.
Thank
Thomas
you.
Schott of Middlebury
Thank
with
you.
the support up Route 7. And, of course, a small matter at KBW, definitive on banking research. What'd you learn there from Mr. Michaud? I learned that, it's sort of like, okay, it was 2 banks and we're beyond.
There are a lot of question marks around the depth of some of the fissures. And I think that sort of the weakness in the economy is the most important point. And the fact that there is sort of a disproportionate lending from these regional banks. And this question around, well, if people do withdraw assets from them, the consequences for the economy are greater. Although I do wonder whether you start to see some of these banks offer higher rates again to sort of lure in some of those deposit bases. And as people start to think about that again, if they get past it and we do get some stability.
I think what's underreported here, and I mentioned Fidelity this morning and some of the Schwab challenges, is I'm old enough, unlike young Michaud and you, I actually remember the shock of what's a money market fund? And I'm still living with that. Those things are over there, away from the land of KBW and Sandler O'Neill and the rest of them, and that money market funds had changed everything, as we all felt decades ago.
You mean because we have to actually care what they invest in to get that extra yield?
Because you look at the BTMM screen, it's a 5% yield.
All of a sudden it means something.
Jamie Dimon's not giving me 5%. I mean,
if the Fed keeps hiking rates, how much does that ratchet up the tensions?
You should see the toasters at the National Bank of Middlebury. They're from LL Bean.
You have them lined up? Yeah.
It's like they're from LL Bean. It's like a New England thing. Coming up, David Rubinstein. Lots to talk there, including his important interview with a leader of Citigroup. Stay with us. At Futures Advance, S&P Futures up 31. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. UBS is going back to the future. Sergio Ermotti is returning to the bank as chief officer to oversee the acquisition of Credit Suisse. Ermotti will replace Ralph Hamers, who has been in charge for just over 2 years. He will retake the role he held for 9 years after the annual general meeting next week. Now, the German government will increase its financial support for Ukraine by as much as $13 billion. The money will mostly be used for weapons. Bloomberg's learned almost half the money will be available this year, more than doubling the current amount. President Joe Biden and House Speaker Kevin McCarthy exchanged dueling letters in the fight over raising the debt ceiling. McCarthy is demanding that negotiations begin on a series of spending cuts and regulatory changes. The president responded by challenging Republicans to produce a public budget plan. Mortgage rates in the U.S. fell last week to a 6-week low. According to the Mortgage Bankers Association, the contract rate on 30-year fixed mortgage declined 3 basis points to 6.45%. Meanwhile, the lower rates helped drive a 4th straight increase in applications to buy a home. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
Banking system is pretty sound, and we're talking about a few banks. We heard it from the chairman Powell today. This is not something that is spread across the entire banking system. This isn't like it was last time. This is not a credit crisis. This is a situation where it's a few banks.
Very important to note that recorded March 22nd, the leader of Citigroup, Jane Fraser, in conversation with David Rubinstein. Look for that important in-crisis full conversation, Jane Fraser, and peer-to-peer conversations tonight at 9 p.m. For those opening in Asia, that's a big deal. Lisa, really extraordinary to see Jane Fraser speaking there versus the conversation with David Weston in Davos. It seems a million miles away.
there needs to be some sense of confidence, not just in the banking system, which the large banks are by all means very solid, but a question around the role of the big banks in supporting the smaller ones. And that's something that came to the fore over the past few weeks.
Someone who studied this, of course, is the gentleman of that interview, David Rubinstein, joining us now, co-chairman and co-founder of Carlyle Group. It's a happy David Rubinstein as he joins us today from his Duke University. Thank you, David, for joining us from Duke this morning. So much of this is a distrust of these major banks. How did Jane Fraser frame that you can trust us this time in this big crisis?
Well, for those who don't know, Jane is, it's hard to believe, but after 250 years of our country's history, she's the first woman to head a major money center bank. She's a native of Scotland, but educated here at Harvard Business School, worked her way up at Citi over many, many years, and for the last 2 years has been the CEO of the bank. Her view is that the banking system is in pretty good shape. Obviously, there are a few problem childs, and they're being dealt with, like Silicon Valley Bank, and maybe you could argue First Republic Bank. And I think what she's saying is that the banking community is coming together to figure out how to solve some of these problems and not relying only on government assistance.
We've spoken today, David Rubinstein, of say there were 3 big Swiss banks in our childhood, and now there's one, I guess. We'll see how that works out. There's also been the turmoil in American banking. Do you suggest in your conversation with Jane, and for that matter all of your contacts, that things are being sped up now for the major banks, that they're going to have to move and act strategically faster in the coming months?
Well, in the crisis of 10 years ago or so, the major banks were, to some extent, with 1 or 2 exceptions, undercapitalized. Now the major banks are well capitalized, leaving Credit Suisse aside. They're well capitalized, and therefore they have more of a ability to help other banks. And so, as you saw in the case of First Republic, the major banks put together money that would go into First Republic as deposits, and hopefully that will shore up the situation until a more permanent resolution. But I don't think we have a crisis where J.P. Morgan or Wells Fargo or Bank of America have financial problems, or Citi. But they clearly, everybody's always nervous when there's a banking problem. But I think this one's reasonably under control.
Do you think that this is the best PR move that ever happened for big banks, because they can basically come to the rescue, be the good golden children, and all of a sudden have politicians coming out and saying, you guys should all be more like them?
Well, I'm sure that might have been in the back of their mind. But the truth is the U.S. government used to come in and kind of resolve these things. But in this case, Jamie Dimon, although he's working with Janet Yellen, has taken the lead. So you have banks putting in the money in First Republic, and that's unusual. You don't usually see that in a kind of voluntary basis, but I think it's good for the system, and it shows how supportive the major banks are of any problems that they see in the banking system.
I love that you were the one interviewing Jane Fraser, because you're 2 behemoths in the industry, 2 behemoths in the financial system that really is the focal point of so many prognostications at this point. From your vantage point and with your discussion with Jane, do you get the sense that there truly is a mass wave of credit tightening that is coming upon us that is going to really become clear in the second half of this year?
Well, interest rates have been going up steadily, as we know, this year, and as a result, there are consequences. One of them is supposed to be a slowing down of the economy and higher unemployment, but one of the other consequences, obviously, is some banks are hurt by this. The general occurrence when interest rates go up is it probably usually helps banks a bit because they can charge more than they're otherwise going to charge for loans. But in this case, what you're seeing is that some banks had a lot of securities which become worth a lot less when interest rates go up, because they had bonds or treasury bills which go down in value as interest rates go up, and that produced a credit hole, obviously, in Silicon Valley Bank, and probably in some other banks there's some modest credit holes. So raising interest rates has not been an unvarnished a good thing for the banks, though generally when interest rates go up, it's not that harmful to banks. Right now, I think the banking system's in reasonably good shape, though.
David, you grew up basic in Baltimore. There's going to be a House committee meeting today going after fat guys like you, the fat cats out there of global Wall Street. I want you to speak to House Republicans today with their immense distrust of the kind of people that blew up SVB. What do you say to people representing a broader middle class of America that say, who are these guys and why are we putting up with them?
Well, whenever somebody loses money, governments always come in and say, who's at fault? Certainly it's not the government. The government would say it's never at fault. So I'm not surprised that somebody will go after somebody that's lost money for shareholders and so forth. But as beating up on Wall Street types or finance people is a relatively common experience. I don't think people are going to be shocked by it. In the case of Silicon Valley Bank, they clearly did some things that the regulators should have been more on top of. And I think under the banking regulations and laws, the Federal Reserve Bank in San Francisco was aware of it and was working on it, but I don't think they did enough quickly enough to take care of the problem.
Oh, that's the question, David, the quickly enough of it. Can we legislate the courage to be quickly enough?
Whenever you have a financial problem and something goes wrong, you always try to have a fix. So Dodd-Frank or Sarbanes-Oxley. But the ingenuity of mankind is such that they can always figure a way around some legislative or regulatory constraint. And so I don't think we're ever in our lifetime or anybody's lifetime going to solve all these financial problems. There's always going to be somebody taking advantage of some rule. So I don't think we can fix it overnight, and we can't just point a finger at somebody and say it's your fault alone.
David Rubinstein, thank you so much from Duke University this morning. An important conversation, Mr. Rubinstein, with Jane Fraser. Peer-to-peer conversations tonight at 9 p.m. In New York. I want to mention something, Lisa, which is in the background, certainly for America today. We do this with the market up essentially 1%, some real nice things. The moment of history going on in Germany right now is absolutely jaw-dropping. It is something unimaginable over the span of 2 world wars and all of the history that we've lived and our parents lived. This is early tape of the King of the United Kingdom and of Great Britain visiting the Brandenburg Gate. And you look at something, Lisa, like Gregory Peck in 12 O'Clock High, which was an iconic movie that shattered our illusions of World War II. We went in there and we had to level it within a war led by the British and the British airfields. And this is the King of England returning here before his coronation. France was a political maelstrom, and here he is in Germany being greeted by the German people. Sir Anthony Selden, who I've talked to many times, a great biographer of Tony Blair and others, and Sir Anthony, speaking to the BBC, makes clear the significance of this is once in our lifetime.
Especially at a moment of war, right? Especially at a moment where the cohesion of Germany and the UK, very much a departure from the 1940s when it was quite the opposite, comes at a time when they're trying to unify a front with a conflict that has not stopped and that continues to rage on in Ukraine. And that, I think, is really the crux of the symbolism at this moment to see King Charles in Germany. The
symbolism here overlooking our Berlin News Bureau in Germany now, and of course the Brandenburg Gate. For those of you on radio, it is that iconic gate that means so much across so many generations and wars as well. Let us get back to what we do at Bloomberg Surveillance, which is just simply, Lisa, we greet a better tape into claims tomorrow and critical inflation data on Friday.
Lee Farage said it. At what point do we rewind 3 weeks and go back to the same playbook that we had when Jay Powell went before Congress and said they potentially 50? Well, I mean, really, this is the issue for me. And I'm looking right now at Fed funds expectations, and they're creeping up in terms of where they're going to end the year. Basically, people saying, well, if things are looking good and it's crisis averted, then why are we suddenly on the verge of Armageddon that's going to naturally disinflate everything?
Oh, look at that. I missed this, folks. Just in the last hour, the 2-year yield explodes. That's the right word. To round it up, 4.12% in the 2-year yield. That's out above new highs early this morning. Please stay with us through the day, including David Rubinstein's important interview with Jane Fraser. Bill Isaac, former FDIC chairman, later. This is Bloomberg. Good morning.